So Siemens is called lower by maybe 3–4% today. We'll see, of course, in the next couple of seconds. But that is potentially going to be a weight on the DAX.
It's interesting as well. We've been talking about what's happening in Germany. The sense seems to also be that German industrials are investing abroad at the moment, not domestically. And that sort of story also ties up with maybe what we're seeing out of Siemens, that kind of narrative about China and how important it's ultimately going to be. Anyway, European equities are about to open post-CPI. What are we going to see first thing this morning? Maybe a more muted day this Thursday as we watch maybe other factors start to represent themselves. There's plenty of single stocks that we do need to be watching. So the FTSE 100 absolutely unchanged, kind of dipping in and out of positive and negative territory already this morning. We're going to be watching EasyJet, we're going to be watching Zurich. We've already spoken to the bosses of those two businesses as well. But Siemens is going to be interesting. It'll be interesting to see whether the technology story continues as well. So technology was the big winner coming out of yesterday. Big tech stocks, Nvidia was a name that obviously was front and center too as well. Does that translate into the sector breakdown that we're seeing here in Europe?
And actually, I think we also saw real estate doing pretty well yesterday. That was part of the narrative here in Europe. Not so impressive, not so standout today. Pretty flat, actually, for that sector. Here, we've got basic resources doing pretty well, up 0.7% or so. So that's the upside, along with insurance, and we've talked to Zurich Insurance earlier on today, and autos and parts moving lower, as well as the numbers out of Zurich Insurance. We've got numbers out of Swiss Re, and I see that stock is really strong today. And I was wondering how this would go down with investors, because they beat on the net line, beat on a number of metrics quite convincingly, but in terms of the guidance, that didn't seem to step up as much as the beats might suggest. So interesting that the stock is up by 1.8% this morning.
You talk about the miners, iron ore just surging in the session today. Again, tied to what's happening, some optimism around maybe the real estate sector in China. We had that Bloomberg scoop around a proposal. It is still a proposal to spend potentially up to $1 trillion to buy up all those unsold homes and units. But iron ore getting a big lift, and that's tying into the basic resources story. We keep an eye, of course, on copper. That, again, is at 10,318, and the gains keep coming for copper. Brent, WTI, also high by around 0.6%. So in the energy sector as well, the focus is there.
There's a lot of ex-dividends in this morning.
Yes.
Just need to count 24, I'm told, including Tesco, Daimler Truck, BMW, GSK, Unilever, SAP, Shell, and BP. So if you're an income investor, today's a fairly big day as well. So that's factoring in on the downside this morning. Ubisoft, though, is on the downside as well. That stock is as a result of what we're seeing in terms of the earnings. And that is in terms of what we're seeing in the percentage drop. That's the biggest drop we are seeing this morning on the downside, 9.26% to the downside. So some quite significant volatility in some of these single stocks.
Yeah, and talking about things moving lower, Eni is weaker. We heard a bit about this from Joe Easton as well. Italy selling a $1.5 billion stake in that energy business, and as a result, that stock is down by 3.4% or so. And we also have positive developments though at Roche. That share price is gaining. The promise of that obesity drug, and I think all you need to say is obesity drug, and certainly in the last 12 months,
ding.
Yeah, it seems to strike a few chords, and so that stock up by 4% this morning.
You either add AI or obesity to your stock ticker.
Yeah.
You're going to get a lift. Down 0.4% on 0.5% on Siemens now. So that trading is coming through now. So we're getting a print on Siemens after the miss when it comes to the earnings, and we talked about the lackluster performance over in the Chinese part of that business, or at least the exposure to China. That stock currently down 0.7%. So not a major reaction to that. A little bit of downside coming through right now. Down 0.8 now on Siemens.
It's interesting that actually the story today feels less about the CPI story yesterday. The numbers came out at 1:30 UK time, so in some ways we have already factored this in. So this morning's trade maybe less to do with that narrative, and maybe we're looking forward and also digesting some of the earnings that we've seen already this morning. It was an important number, and we had some great coverage yesterday. This is what some of our guests had to say about the data we saw yesterday.
Inflation it's taking its sweet time coming down, but we still think it's a downward trend.
The big picture on a core basis is that the rate of inflation has come down a lot.
Really great set of data, I think, for the Fed, especially on the inflation front.
This, to me, is a chair who wants to cut. I think that, and you can easily see one, and I think if he has the opening, I think he'll do two. And I think data like this, if it persists, I think that'll give him that opening.
I don't think July, but I do think September is possible.
We need to see more weakening in the data, especially on shelter inflation, for the Fed to begin to gain confidence and get comfortable in terms of beginning to ease rates.
The truth is, I don't think that we're heading into a higher for longer environment. I think we're heading into a normal for longer environment. Yes.
A host of voices there on Bloomberg TV, guests from JP Morgan, from PGIM, from BlackRock, reacting to the step down in US core inflation. Joining us now with her views, Shikha Gupta, investment committee member at Astra Asset Management, which specialises in alternative credit. It's very nice to have you with us, Shikha. Let's get your response then to the data we had out yesterday, to the inflation data. It seems the market has gone back to pricing in Fed cuts, happy days, Goldilocks back in the building. What's your assessment of what difference this makes to the corporate landscape?
We see that the data has inched down from the peak, but I still don't see anything that would warrant a significant monetary action from where we stand. As we have already seen yesterday, if you compare pre-GFC world to what we see today, all the way from World War II to GFC, the long-term Fed fund rate has been around 5.7%, and we are at around 5.5%. I think there is, if I have to make a case, there is a better case for a rise than a cut. Would they cut? Would they rise? Probably not. Feeding that into corporate defaults, I think they will remain quite muted. Just like we have seen in 2023, it's not going to be a surprise this year that the cost of debt has gone up.
Okay.
Corporates have remained profitable and have attended to their debt maturities. So I expect it to stay quite muted.
Okay, it's interesting that the way that history has played out then, Shikha, because when rate hikes started, a lot of people looked at the profile of European debt and said there'll be these walls coming, debt walls, and refinancing will be required at higher rates. That's going to be difficult. Why has that not been more difficult? Has it been because profitability has held up, or is it for other reasons?
Absolutely, and corporates who have been around for more than 15, 20 years have sustained higher rate environment, and we already see some credit dispersion, so I would not say there hasn't been casualties, but we also have to admit that there are better solutions out there now compared to just putting a higher debt coupon on debt. So, you know, private debt is one example for that you are able to find more structured solutions now than just having an outrageously high amount of debt coupon, which has really helped corporates to find their runway going into future.
You say you see more credit dispersion than massive corrections. Just unpack that view.
So the credit dispersion has already been underway. Most of the corporates have sustained the higher rate environment, be it like profitability, be it attending to their debt maturity. But there are some corporates whose operating model just cannot thrive the current rate environment. And they would probably will suffer.
Where do they sit, those corporates? Which sectors?
So we have already seen most of the defaults coming in, for instance, in US from telecom, for instance. In Europe, also like media, healthcare. So debt that was, or the growth that was fueled through a very, low interest rate environment, primarily through debt, those operating models will have to change, in my view.
Morning. We all wonder, we spend our time wondering what is going on behind the curtain inside private credit. You're painting a reasonably benign picture, basically kind of signaling that alternative financing sources allow companies to continue. Is that something that is storing up problems for the future, or is it just giving these companies time to be able to adjust their business models to be able to have a future? I.e., are we just kicking the can down the road, or are we changing the shape of the can?
I mean, to many people's surprise, no lender wants to foreclose on a borrower.
Yeah.
The first thing they want is to provide some sort of a runway and give them a chance to survive and adjust. And even though private debt or private credit has its own set of challenges, I do feel that they are very, very well monitored when it comes to, they have to be paying their coupon every month or every quarter, so there is a test. Most of the debt have covenants like a yearly LTV covenant, an ICR covenant, like the interest coverage ratio covenant. So there is a lot more monitoring and room for monitoring any migration that would come in for lenders to come in to foreclose if they really want to. But it does provide a runway for them to, find a way to navigate.
Do you think investors at the moment are more focused on the kind of the yield they're getting rather than the credit risk they're running? At the moment, everybody seems to be focused on the duration side. We can lock in some duration, we can get better yields. You've already indicated what is happening in terms of the default cycle looking kind of fairly well managed at the moment. But do you think we are underplaying the credit side of the risk profile?
I mean, you're absolutely right. It's a great time for credit investors to lock in higher yields. Being a credit investor, CRE, for instance, you are able to generate equity-like returns for a very low LTV debt. So there is a good opportunity for that. But at the same time, I think, given the credit dispersion, investors have to be really careful in their underwriting as well. And they need to just capture where they feel the real value lies and where there is a real, credit robustness lies.
Shika, you talked about how, lenders don't want to foreclose, and the first thing they want to do is offer some kind of runway ahead for borrowers, and that might very well be the case. But you also make the point in your notes, and other guests have as well, that the last 15 years in terms of rate environment, they were an anomaly. And so we don't expect to go back to rates as low as they were post-GFC. And so we maybe linger here higher than previously for longer. Doesn't that at some point have to crystallize? What is the result of that?
So, for us to see more defaults, there is one basic thing missing, which is acceptance between both lenders and borrowers. So, of course, even if you look at credit and CRE, both lenders and borrowers have to accept that the pre-COVID valuations are not viable anymore. In CRE space, if you look at office, there are structural changes in terms of the actual demand. And of course, the rates have also moved. So both parties have to take some sort of a hit. And until that happens, we are likely to see more of this muted effect in terms of amend and extend than actual transactions hitting the market.
When does that reality hit?
That reality takes a long time. There is not an easy fix like we saw in retail 10 years ago, and we are still repositioning, and the changes are still underway. Office is going to be a very similar story. It will take a long time.
Shika, thank you very much. Thanks for joining us. Shika Gupta, Investment Committee member at Astra Asset Management. That's the story around credit this morning. Let's go to stocks.
Let's talk more about what we're seeing in single stocks. This is what the Core 6 looks like this morning. Some interesting things happening, I think, obviously, in the pharmaceutical space. It's interesting that Roche is having some positive stories surrounding what is happening. Its obesity drugs. Is there any impact on Novo Nordisk this morning? Not much, as you can see. That stock down by 0.4%. Interesting to see that the tech stock story, though, does continue on the upside. ASML posting some positive performances this morning, maybe ignoring the Dutch politics story and focusing instead on the positive performances we saw yesterday. Interesting that maybe is the narrative that continues here in Europe. Nestle a little softer. Schneider Electric, the AI play, to many, up by 0.3%. What else are we watching? There's some pretty big moves this morning. There's quite a lot of volatility in single stocks that we need to be paying attention to. Joe Easton's got all the details there.
So we've got lots of red on this first screen here, particularly over in Germany. We've got Siemens coming down around 2% this morning, perhaps not as much as it was on the Tradegate pre-market exchange. Earlier, they have reported this drop in their factory automation business in China, cutting the guidance, but that was already predicted by some analysts, taking the sting out of that. So down 2%. Deutsche Telekom, meanwhile, they are seeing an improvement in the domestic German market, but not as much as some people had hoped, and that one is slipping very slightly. But take a look at Ubisoft. It's one for the gamers. Assassin's Creed, Call of Duties, all those games getting absolutely slammed, down 13%. A massive miss on orders in the last quarter, according to their statement. I don't know too much about those games. I'm more FIFA, a bit of Grand Theft Auto, but Call of Duty Ubisoft is getting hit on that one today. Then we've got Umicore. This is in the chem space. They are actually announcing a change in CEO, a bit of a surprise, warning of weakness in EV, so electric vehicle batteries. That is where the weakness is in that one. That's over in Belgium as well, so that one coming down 8% today, a big decliner. And we've got some big movers in the UK as well. There's EasyJet you were discussing with the now outgoing CEO, but we are seeing some weakness in some of their bookings, though the travel business, as you were discussing, the holiday business, looked pretty strong. So that one actually falling almost 6%, a pretty big decliner there. BT going the other way, strong numbers, a strong dividend once again from them, so they're doing okay. And Watches of Switzerland rallying. This stock's had a really tough time given a slowdown in Rolex watches, particularly in the US. It is, of course, a big player in the US and the UK as well, but we're rebounding today, up around 10% almost. Sage Group, this is in software, it's accounting software. It fell about 20% at the open of trading in London today. We're trimming that to 5% at the moment down in London. Still one of the biggest decliners. Again, it's on orders. The backlog not looking as strong as they had hoped. Then we're going to move over to the deals as well. There's a couple to bring you. We discussed Eni earlier. That one falling 3%. A discounted share placing, more than €1 billion from the Italian state, and that one coming down with that price. And then Evonik, that's a share placing as well. Again, we're back in chemicals, a seller over on that one. And I've brought up IDS. The Royal Mail owner got that bid yesterday. It was at 3.70. We're only trading at 3.19, suggesting maybe the UK government might just block this deal, so people not getting excited. They don't think this will go through for now, but it has got a bid from the Czech billionaire, and that one is adding to the gains yesterday, but well off the 3.70 price for that one. Then we'll look at miners, a massive jump in the Chinese property stocks overnight. One of the indexes there was up 12% as the government looks to pump money and pump bonds into that market. So I brought up the miners to see what we're doing in terms of copper. They were up a lot pre-market. Copper was up 2%, but we're pretty much trimming some of those gains. There are, of course, single stock stories with Anglo American in the spotlight in terms of M&A as well. Then I'll look at Roche. You mentioned earlier that obesity drug data. This is Roche's biggest gain in 3 years, so you can see how that stock really doesn't move too much. This was part of their deal for Carno Therapeutics. They bought in the US last year. It's got promising obesity drugs. However, analysts at Vontobel warning that this might not actually come to the market until the end of this decade. So it's a long way to go. Novo Nordisk probably going to be the market leader for a while, but Roche is up almost 5% this morning.
Wow, end of this decade. Yeah, that's a long time horizon, isn't it, Joe? As they all look to add those obesity drugs. The argument that maybe this is a bit of fad seems to be fading, at least for these drug companies. Joe, thank you very much indeed with some of the big movers. EasyJet really tumbling right now, currently down a little over 7%. I wonder your views on whether or not this is a reaction to the CEO executive leadership change that we see, which was a surprise after 7 years at the helm. He's overseen, by the way, a stock that's fallen over 50% since he took over in the end of 2017. Or is this just a market that was primed for a slightly better results? They essentially matched the estimates.
It's always nice when you're a CEO, when you announce that you're going to step down and the stock drops. So in some ways, probably Johan is not too displeased with this, but it is still a drop in the stock, so he probably is displeased. The line that really stood out for me from the interview was, it's too early to determine fares this summer. Michael O'Leary the other day was talking about the fact that he was seeing 0 to 5% fare growth this summer. Yeah. The original expectation was we were going to see 5 to 10%. So that's quite a material change. Johan's not willing to call it yet, which I think is interesting as well. I think if he had more clarity, he probably would be able to. But there's a little bit of clouds there, I think, probably to clear.
Yeah, there's something interesting about that, isn't there? Because on the other hand, he did say things that sounded like quite a positive story, talking about the run rate of bookings around the summer, how much better they're doing this time than previous time. So all of these things sound quite positive, but for whatever reason, not with the confidence to give that guidance on pricing is interesting. But a lot, as you said, Guy, a lot of volatility around individual stocks today.
Absolutely, and it's a theme that continues. yet at the aggregate level, maybe not so. Talking of volatility, if you want to talk about volatility, this next story takes you definitely to volatility. Roaring Kitty getting a little quiet over the last few hours. The meme stock rally fizzling a little bit yesterday. We gapped lower yesterday, as you can see on the stock, and then maybe climbed back as the rest of the session developed. Has the meme stock rally faded? GameStop shares taking a little bit of a tumble yesterday, but still on a two-day basis, they are higher. We'll talk about all of this next. Probably a few 13Fs to throw in there too. We'll do that next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. To the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
This is Markets Today. We are 21 minutes into the European trading day. You're seeing modest gains across the European benchmark of a little under a tenth.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar, something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
I'm just going to take.
Here's my option to exit.
Is there some broader story around the consumer attached to this then, Charlie?
I think one narrative you could take from this, if you think about retail traders, you think about them as consumers, you know, sentiment for consumers has been pretty bad across the board, but then there's been this strange story where behavior has actually been good. We've seen a lot of spending continue.
People going to Taylor Swift concerts.
Just like me going this weekend, even though my sentiment's not great, but they're speculating, right? If you are a retail investor buying into AMC or GameStop, that is speculation. I think everyone, including these people, know that. But, you know, does that continue? I think that's the real question here. And the other big one is, was this retail or was this institutional?
Talking of institutional, 13F filings, hedge funds, some of their positioning. What are some of the key kind of themes that came out from that detail?
And it's still continuing to come out, because I think do we get more today?
Yeah, so these will be rolling in. Bloomberg has so far analyzed well over 1,000 of these 13F filings, and they really show kind of where the smart money has been playing. What has stood out, at least in the realm of hedge funds who've had to make these disclosures, is tech. Of course, we've seen a huge piling into NVIDIA, surprise, surprise there. But two big names, I think, indicated some interesting moves. One was Michael Burry, his Cyan Asset Management, actually kind of backing into Chinese tech, so JD.com, their largest holding, which we're seeing in these filings. But also a mystery that we've been talking about for a while now was Warren Buffett. And so what we have seen in previous filings was an accumulation of stakes in some kind of financial company. We finally got the name of that financial company in these 13Fs, and that's Chubb. That is an insurance company. It's one of the largest in the U.S. They operate in 54 countries. $6.7 billion stake in Chubb by Warren Buffett.
Okay, Charlie Wells, thank you very much indeed on the meme stock frenzy that seems to have faded, at least for now, and some of the detail around the 13F that continue to come out. You talked about NVIDIA. The earnings are out next week. The stock is up 90% year to date.
Yep. And it's rallied back recently. So it's come, it dipped, and then it's come strongly back. So yeah, we're kind of, I think we closed for 946 yesterday. We're kind of at 52-week highs. I
wonder if there's a sort of viral phenomenon theme that links these. You know, we've got meme stocks, which was certainly a viral phenomenon. Taylor Swift, to some degree, a viral phenomenon, although very much exists in the real world. And NVIDIA capturing a lot of attention from individual investors as well.
Yeah, to what extent the retail investor play is there. 951 right now on NVIDIA in terms of that stock. And to what extent it is still the most important stock in the world, as Goldman Sachs said a few weeks ago.
22nd is the numbers here?
Yes.
Okay.
We will come back with some politics for you, some European politics for you. We are, of course, monitoring what's going on in Slovakia. We've had updates about Robert Fico. He had 5 hours of surgery for multiple shot injuries. His condition in hospital, we'll get an update on that shortly. This is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want. With the
politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Or other authorities.
Could face bigger challenges. Brussels next.
Fed was going to keep rating World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome back. You're watching Markets Today. We are 30 minutes into the trading session. As you can see, we're seeing actually a fairly muted session developing, quite in stark contrast, you could argue, to what we saw yesterday in the United States, where actually we got a bit of a rip on the back of the CPI retail sales number. The market kind of firmly believing, Tom, that we were in Goldilocks territory.
Yes, the FTSE 100 being hit certainly by the downside that's coming through for EasyJet, so that's a drag on the FTSE 100 so far in the session. Basic Resources you thought might have been a lift, but no, it's the airlines that are causing the drag on the FTSE 100. Let's cross over right now, though, to Paris, where Francine is standing by at the JP Morgan Annual Global Markets Conference in the French capital, Bloomberg's Francine Lacroix, of course, on the ground for us with a great guest. Morning, Fran.
Yeah, good morning, Tom. I'm really excited being here. The JP Morgan Chief Economist, Bruce Kasman, joining us. It's buzzy. We're here at the Global Markets Conference in Paris. Bruce, thank you for joining us. It is buzzy. It's almost as buzzy as the markets yesterday after that U.S. data. Was it too much? Do you find the markets frothy?
Well, I think markets are correctly responding to the environment that we're on a sustainable growth path for now, that while inflation is elevated, central banks are not going to fight you. And that, I think, is something that markets like. I do think, however, that we're not getting inflation down. We're probably not going to get as much easing from the Fed and other central banks that markets are pricing in here. And there's a risk that central banks looking at what markets are doing now might calibrate their rhetoric in a more sober fashion. So I think you want to buy sustainability, the expansion. You don't want to buy central banks being quite as friendly as markets think they are right now.
But Bruce, how can we be so sure, actually, that the next move from the Fed is down and not up, given that the inflation dynamics that for the moment are fine, but they're also not, you know, extremely favorable to what the Fed needs to achieve?
Well, I think the biggest reason that you should look for the next move from the Fed to be down is because that's what the Fed is telling you. What they're telling you is that even if inflation stays elevated, as long as they have a comfort level that it's on a trajectory down, they're going to be willing to move. That's what the ECB is telling us. That's what the Riksbank told us. So I think that's a reasonable expectation. I think what's important about yesterday's number was not that it was so low. 0.29 unrounded core was not a low number on the month of April, but it's probably not enough to shake the Fed from that path. And I think that's the important message. Could we be shaken from that path? Yes. Is it likely we're going to be shaken from that path in the next 3-6 months? probably not, and markets like that.
But Bruce, if you look at the U.S. economy, I mean, it's not at all what the European economy is doing, or even you know the UK and the Bank of England. It's like firing on all cylinders. So do you see any stress points of actually an economy that's overheating?
So I think it's hard to call it in a traditional way overheating because we're unwinding the very elevated inflation. We are seeing labor markets move somewhat more in balance. The question is, are we getting enough shift in the environment to bring inflation all the way back down? And I think the answer to that is no. I think the Fed is going to show patience and might even ease somewhat. I think you're 100% right to identify the divergence between U.S. performance and European performance, which has been much weaker and probably justifies some rate cuts. But the Fed looks like it wants to calibrate what it perceives to be a restrictive stance as we're making somewhat more progress. I think that progress is going to be limited, and I think the Fed has got to be somewhat worried about how financial markets are adding fuel to the fire as we look forward from here.
They don't look very stressed on that point, actually. Do you think the Fed and central banks in general should pay more attention to what to what actually market exuberance does to the economy?
I actually think, to me, the most surprising element of Fed rhetoric in the last 6 months has been the willingness to think monetary conditions are going to weigh on the economy when it isn't spilling into financial conditions, which have been on a straight-up easing path. When will the Fed start to get more worried about that and start to change its tune? I would have thought that would have happened already. I think it's a significant risk here, but I can't feel confident that that's going to happen as we move to the June FOMC meeting.
I mean, do we care about the neutral rate, or is it just, it's actually almost impossible to call out?
Right. I think neutral rates are higher. How much higher they are, you know, I kind of take the view that normal is as normal does, which is that you're going to read the data. I do think the U.S. economy is cooling as we're going through the first part of the year. I think you see it in the survey data. I think you're starting to see it in some of the activity readings. The U.S. economy grew 3% last year. It's going to probably grow closer to 2% this year. It's not weak, but it's not quite as exuberant. And I think, again, the issue here is we still have sticky inflation, and how much is the Fed willing to run with that and still ease? Right now, they're telling us, and I think they will at the June meeting, they're still on track for doing at least 1 or 2 eases in 2024.
But Bruce, is it right that actually, you know, markets and to some extent also central banks are ignoring geopolitics? I know it's not really playing out in economies, but we're kind of redrawing on supply chains, but actually, you know, trade agreements that could really change the way we do business in 12, 18 months.
So I think if we're looking at the horizon of a year, I don't think geopolitics is having much of an impact on what we're seeing in inflation or growth data. I do think there's some risks that there could be a more substantial event, but I think that's hard to use as a tool in terms of setting policy. I think there's obviously big implications of how geopolitical events, and including, of course, the U.S. election is going to play out over the next 2 or 3 years. But I think it's correct for central banks to stick it to their knitting right now, you know, drive their policy decisions off of what they're seeing on growth, inflation, and I think on financial conditions. And it's in the financial conditions space where I think the Fed has some more reckoning to do with how it's been communicating with us.
Does the Trump administration actually change the U.S. economy in the next 12 months from when, if he gets in the White House?
I think the election matters. I think if we're going to have a divided Congress, which seems a reasonable expectation under either side, I think it will change U.S. policy regardless of whether Biden or Trump comes into power. I think what worries me about Trump, and certainly at our conference this morning, people were arguing for Trump being a risk-on trade. I'm less confident of that in a world in which I think the U.S. has been helped a lot by our interactions with the rest of the world in terms of immigration, in terms of trade. And Trump wants to change that. He wants to close that off. And I think that's a danger to the expansion. And we're not likely in a divided Congress world to get a fiscal easing, which is what we got in 2017 and 18 under the first Trump administration.
And immigration actually has been pretty pivotal in some of the productivity numbers, right, in the U.S. It's almost a direct impact.
It's had an impact which I think people have most clearly identified on the supply side, and particularly labor force growth. And that, I think, is genuine. But I also think it's been underappreciated how much it's probably had an impact on demand, on housing demand, on consumer demand, on government spending. And therefore, from the point of view of the Fed and the inflation outlook, you have a little bit easier labor markets as a result. You have somewhat firmer pricing power, and I think the impact on inflation is not as easy to identify.
Bruce, when you look at Bank of England, ECB, when you look at BOJ, I mean, that's certainly not dull. And China, what do you think is most interesting right now, more complex for investors to figure out?
Well, I think what is most interesting right now in the immediate sense is the fact that the Europeans are moving before the Fed, that they're moving with still elevated inflation, which is very unlike particularly ECB, and that they're making a call here, which I think is correct, actually, that the legacy of weak growth over the last year, which is not the environment the U.S. was facing, does warrant rate cuts. So that willingness to move in a still sticky inflation environment is very unlike ECB from the past. And that's the most interesting thing. I think perhaps what might be the most interesting thing over the next year is the BOJ, which has a significant amount of pressure coming from what we think is a weak yen, continued pressure on inflation, and what we're expecting to be is a substantial lift in Japanese growth if we're right that the rest of the world is doing well. And I think the market is underestimating what the pressure might realize in terms of BOJ action when viewed over a 12, 18-month horizon.
But Bruce, market expectation is now ECB goes, probably Bank of England goes, and then it's the Fed. I mean, how, this gravitational pull towards the Fed, how difficult does it make the other central bank's job? And do they cut once and then stop? And this would be like any other cycle that we've seen.
So I think there's probably less gravitational force from the Fed coming from the dollar or from any direct transmission, except for, I think, the financial market condition channel. If global financial conditions are really doing well, if European financial conditions are doing well, central bankers might have to think somewhat twice about how much they ease and how much they diverge from the Fed. We don't think the macro fundamentals are going to warrant a big divergence between European central banks and the U.S. in an environment in which we have European growth picking up, growing over 1% this year. Not exciting growth, but clearly better growth. I would say you probably are on track over the next 6 to 12 months for ECB to maybe moving once more than the Fed. That's not a big enough divergence to start to get really dramatic about. And of course, macro surprises can change that, but that'd be our call right now.
Bruce, I just got back from Doha, where we also had Ken Griffin, and he was really kind of scathing on debt in the U.S. And he says, look, at some point there's going to be an auction that's going to go terribly wrong, and it will wake everyone up. Do you worry about some kind of big auction credit event happening?
So I think we should understand first and foremost that we've built up a lot of public sector debt. We have not addressed our deficit problem yet, but we've bought ourselves a lot for it. The U.S. has outperformed the rest of the world substantially since the pandemic. We've generated over $40 trillion of household wealth. So from the point of view of a sustainability perspective, this is not really a serious problem. From the point of view of, are we going to show responsibility to unwind that fiscal support? I do think the arguments that if the markets start to see the political environment of the U.S. completely ignoring the adjustments that need to take place and not showing responsibility, I think there is some risk that markets start to price in more credit risk, higher interest rates, and I think we should focus on the political economy, and obviously what's going to matter there is how policy shifts after the election later this year.
Bruce, thank you so much for joining us today. That was, of course, Bruce Kasman. We'll have plenty more from JP Morgan throughout the day. Back to you in London, Guy.
You certainly will, Fran. Looking forward to the conversations a little bit later on. Thanks to Fran, thanks to Bruce for now. But Francine will be back at the JP Morgan Global Markets Conference that's taking place in Paris. The main event, of course, is going to be a conversation with the bank's CEO. He, of course, is Jamie Dimon. That conversation happening at 1:15 p.m. London time. Looking forward to seeing what Jamie's view of the world looks like, maybe from a European perspective. Bruce, I thought was really interesting there. My main takeaway was that he was talking about this idea that financial conditions have eased significantly, and the Fed's been responsible for that. It started in December. You've seen the effect of it. At some point, he thinks that actually the Fed's going to have to start paying attention to kind of what is happening with its effects on the economy and the easing of financial conditions and how that's affecting financial markets, which is then feeding back into the economy.
We're back into that circle, aren't we?
Yeah.
How much the Fed's communication does the work of the Fed for it, so it doesn't actually have to deliver on those things very quickly, as you say. What stood out to me, actually, was the number of mentions we got of fiscal policy. And as we head into an election year in many parts, and we're in it, of course, in many parts of the world, but notably in the United States, his reference to political economy. These are not just economies now. These are very political economies, and taking note of that and the different policy trajectories or the similarities between them for the next president will be really interesting.
Really interesting on President Trump, a potential President Trump in November, and saying that he was pushing back against some of the views in the room there, that this was going to be a risk-on event if Trump wins in November, suggesting he's not going to have that fiscal room. He said, look, I'm not as concerned as Citadel, at least Griffin is, around the debt load in the US. But in terms of that fiscal space that a President Trump would have, it's not going to be there, and he's concerned about the relationships between the US and those open borders in terms of trade that might well be closed off.
It kind of depends who's in the room, though, doesn't it? Like President Trump, in the past, has delivered quite significant tax cuts. I remember the night that he was elected, everybody finally kind of figured that out, kind of a few hours in, and suddenly the markets took off. And basically the people in the room there are likely to benefit from the significant tax cuts if re-elected that he's already said that he will deliver. So maybe it's just risk on for them.
Okay, and somebody who will be focusing very much on the US politics, and the result there will be China and no doubt Russia as well. Coming up, we'll talk about how this meeting of politics and economy plays out over in Asia. Vladimir Putin is in Beijing for talks with President Xi. We'll discuss what the state visit means for the US, for Europe, and for the war, Russia's war in Ukraine. That is next. This is Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
This is Markets Today. We're 47 minutes into a European trading day that looks increasingly negative, actually. Although at overall level, we seem to be flat, but the FTSE 100 down by 0.3%. We've got a lot of ex-divs going on, so maybe that's having a bit of an impact. The CAC 40 down by 0.3%. In terms of the sector breakdown, actually, we're kind of half and half, negative and positive. Let's pivot to some of the geopolitics that could be weighing on sentiment of late. Russia's Vladimir Putin is in Beijing for talks with President Xi as Russian forces press ahead with a new offensive in Ukraine. China's leader welcomed his Russian counterpart as he began a two-day state visit. Let's get analysis now with Bloomberg's Rebecca Chung-Wilkins in Hong Kong. Rebecca, tell us what we know then so far about this visit. We're showing pictures of it now. We were talking at the top of the program about whether the exchange of words has been as friendly this time as it has been in the past. What do you take away so far?
Yeah, a very warm welcome. And we kicked off, with that classic state visit, welcoming Putin into the Great Hall of the People. And he's met a flurry of people, not least that sit down with President Xi Jinping, but also smaller and larger groups. And we're now sort of getting to the denouement of today, at least in the Asia Day. We have had a signing of a deal involving things like cars, potential news cooperation, and plenty of warm words about the types of cooperation that we're seeing. Putin very much suggesting that the stress and the emphasis of talks has been on trade and investment, although he did say that they are planning to discuss international issues later. And in terms of sort of the geopolitics, we haven't had an enormous amount of sort of direct color on that. President Xi Jinping did say that he thinks, in his words, that the direction of what he calls Ukraine crisis is correct so far. So sort of affirmative in that sense.
Rebecca, there are tensions in this relationship. Yes, they've met a little over 40 times so far, the two presidents, but there are some undercurrents of tension, at least historically. What are those?
Yeah, absolutely. I think there's a real sort of distinction here between the relationship between Putin and Xi Jinping. They've celebrated birthdays together. They've met more than 40 times. President Xi Jinping, since coming to power, has met Putin more than any other single leader from any other country. But when it comes to China and Russia, there are these longer standing issues. So, for example, the concern and the threat, the worry that Russia might use nuclear weapons when it comes to the war in Ukraine, that has a sort of personal resonance with China that has previously said itself to be sort of the victim of Russia's nuclear blackmail in the past. They've had disputes over their sort of shared border, for example. And there is a bit of this sort of push and pull over the economic reliance. On the one hand, Russia needs China to continue buying its energy and so on. But on the other, China itself has somewhat dragged its feet on signing deals, for example, to do with Power of Siberia 2, which would provide sort of longer term support to Russia in that context. And there is a bit of this feeling as well from China's side of not wanting to rely too heavily on one single country for things like its energy security and so on. So there is certainly these sort of other tensions, these push and pulls and limits that we have indeed seen to the so-called no limits relationship since the outbreak of the war.
Rebecca, great update. Thank you very much indeed. Rebecca Chung-Wilkins joining us out of Hong Kong on the meeting that is taking place currently in Beijing. Let's give you another geography. I want to take you a piece of geography. I want to take you back to Doha. The Qatar Economic Forum is underway, third day. Let's listen in to EQT CEO Kristen Sinding, who is on stage in conversation with Bloomberg's Eric Shaska.
To AI, they worry, not without reason, that all the value is going to accrue to the LLM developers, right? The OpenAIs, for example, or the real arms merchants, the NVIDIAs.
Yeah, you could argue that, and I think Google itself is concerned, right? Because if you use ChatGPT, you probably do, I do all the time. That means I'm not using the search mechanism any longer, and that powers a huge part of their income, right? The whole advertising model, the interactivity, the cookies, all these kinds of things. So their business models are changing. So I think there's certainly shifts in business that are going to be impacted by this across many different types of companies and value chains. But if you look in the long term, you think the next generation now is introducing voice, video, interactivity at a scale which we've never seen before. Maybe the change that's coming is about the same as when we got the iPhone first. And of course, all the applications that are needed to handle that. And even we also invested another angle into this, which is tech services. So primarily Indian companies that are helping companies move into the cloud or move into AI, because almost every industry is impacted by AI. Very few people have the competence. So if we own the companies that have that competence to help them, there you go.
The reality, of course, is that EQT is a $250 billion firm, and you invest not just in AI, but in technology and other areas. Let's talk about technology as distinct from AI. How do you think about it, and where are you looking for opportunities?
Yes. So if you look away from AI, we're investing in a number of different areas across the firm. We're trying to find long-term secular themes in society. One of them is the digitalization of society. Mm-hmm. The other one is, let's call it sustainability, moving to new energies, for example, as fossil fuels over time run out, and the aging society. So the number of themes that we demographics. So and that goes into the healthcare space. That's a big part of our business. The other big part of our business is technology, and there we invest in software companies across all value chains. Really, we invest in technology companies that are serving some of those sectors that I just mentioned, serving these. The green space, agri-tech is a big area, and then we have industrial technology companies, so robotics, automation, humanoid robotics is a very exciting space. We own a company called 1X, which is one of the possible winners in the humanoid robots race. Time will tell. It's very early. So if you think about technology, it's an enormous space, actually. And what we try to do is try to find the mega trends, break that down into trends that we can invest behind, and invest from different angles into those trends.
Could you be a futurist for a moment and share with us what you think a humanoid robot is going to be doing for us 10 years from now?
I think you'll come into the Bloomberg office, and the humanoid robot will receive you in the reception, help you find your meeting rooms, serve you coffee, clean the offices when everybody's leaving. Security, handling security, that kind of stuff. But also, if you break it down into another part of the world, like warehouses, for example, the robots can, of course, work 24/7. They don't get back pain or neck pain. They're strong.
Okay, that is Bloomberg's Eric Schatzker alongside the EQT Group CEO and Managing Director Christian Sinding, talking about the investments around AI and the broader tech space, of course. Let's get back to the earnings story. Siemens, a disappointment, at least the investor reaction, the stock market reaction to that, currently down 2%. It was a mixed picture in terms of the details that came through. Let's take a listen to the CEO, who was in conversation with Ollie Crook earlier.
If the argument is about overcapacities in the automotive industry, for example, there always have been overcapacities. So what's the level? Does it really impact too much? I didn't expect really that the Chinese market would really substantial flooding the American market with the EVs. I don't believe that this is such a strong demand there. Same for Europe. So therefore, I do not believe that this has huge impacts. But I mean, this tariff and counter tariffs is maybe not what we want to see in a market which is start to picking up in growth in general.
Okay, the CEO of Siemens talking to Oliver Crook on the back of the earnings, the disappointment around the key digital industries division where they actually downgraded expectations. Other parts of the business looking a little bit more robust, but the China story and the exposure there is not helping things at this point.
Ubisoft is down really hard this morning. Sage Group under real pressure as well. EasyJet down by over 7%. We've already asked why we think EasyJet is as soft as it is this morning, but it's interesting to see what is happening here. But BT Group bouncing back quite strongly.
Exactly. On the other side, we have a BT Group share price that's up by 9.5%. Roche surging on that obesity drug news, up by 3.6%. And some of the insurers doing pretty well. We spoke to Zurich Insurance a little bit earlier on pricing, sounding pretty robust. That is it for markets today. European stocks flat at the overall level. Some weakness in Paris and London, though. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua, today live from the JP Morgan Global Markets Conference here in Paris. Now, here's what's coming up on today's program. Global stocks rally with the S&P 500 hitting another record high as cooler U.S. inflation reinforces bets on Fed rate cuts. While Slovakia's prime minister is in a serious condition after being shot in an assassination attempt, the first European leader in more than 2 decades. Plus, Xi Jinping tells Vladimir Putin that China-Russia ties should last a generation as the Russian leader receives the red carpet treatment in Beijing. So, as corporate leaders and, of course, investors gather here in Paris for JP Morgan's Global Market Conference, we'll have some pretty big interviews on the economy and, of course, on politics. The highlight, 1:15 p.m. London time, we'll all be speaking to the bank's chief executive, Jamie Dimon. Now, let's also take a look at the European markets map. Now, yesterday was pretty extraordinary. We had data from the U.S., and we saw a rally, actually, stocks at a record high. European stocks, today you can see the European markets map really hovering near record highs again after that U.S. inflation data reinforcing bets that the Fed will start cutting interest rates this year. Now, there's much more improved risk appetites or improved appetite for risk assets. And that, of course, because of the CPI figure, easing maybe some concerns that inflation was entrenched. So we have a lot of market commentary saying that's maybe a little bit premature, but today watch out for a raft also of European central bank policymakers due to speak. Traders almost fully pricing in the likelihood of 3 cuts for the year, kicking off next month for the ECB. Now, to talk about markets, to talk about the Fed, inflation, and everything in between, I'm delighted to be joined by Richard Tang, the global head of markets at Rockhouse Capital, for an exclusive conversation. Richard, so good to speak to you, and in Paris, and the day after CPI numbers from the U.S. Is the market just too optimistic about actually what the Fed does next?
I think so. I think there is an assumption in the market that you can extrapolate this data, and we've seen this happen many times in the past, where you have an extrapolation of the data, and only to see that really change significantly over the coming months. And I think if you look at this data, it was more benign, but at the same time, if you look at 3-month trailing or 6-month trailing core CPI, you're still at 4%, 4.1% on 6-month trailing. So I wouldn't say that we're close to the Fed's target of 2% yet.
So, Richard, I mean, is it odd that the central bank is not trying to actually keep market expectations a little bit lower? Because that feeds into financial conditions as well.
I do think that it's odd, but I think we are in a different era today. After the last 20 years, central banks have become very addicted to giving forward guidance to markets. And at the same time, markets are very addicted to getting forward guidance. So everybody wants to hear what the Fed intends to do with policy. I think the problem that you end up with is that forecasting has become very, very treacherous. I think if you look at the last few years since COVID, forecasting has been very, very difficult for central banks. In 2022, for example, if you look at the year-ahead forecasts by the Bank of England and also by the ECB, they were off on their year-ahead CPI forecast by 7 to 10 percentage points in 2022. And
you're right. I mean, last year we had it all, right? Fed expectations, even in terms of economy, was like we'd have a hard landing, soft landing, then it was a curve landing. I mean, we've had all scenarios. Why is it so difficult? And also, why is it so difficult to predict the monetary policy tightening of last year, how that feeds into future expectations?
I think it's very difficult because it's always hard to know when the regime has changed. You're always the last to know when a regime has changed. And I think even if you go back to, let's say, the mid-2000s, when the Fed was tightening rates at every single FOMC meeting between 2004 and 2006, Greenspan was talking about the conundrum. He couldn't quite understand why long rates actually rallied about 100 basis points in the first year of this tightening. So that was a major regime change when globalization and demographics became a real factor over the last 20 years. Now, I'm pretty confident that we're in a new regime. And I think the conventional correlations of econometric models are no longer applicable. Right? Those correlations have changed. And how inflation is actually formed, I don't think anyone really knows. I think we're struggling to understand inflation and whether it's the economics community or the policy community. I mean, this is a debate that has been going on since the creation of money.
But Richard, so we also struggle to understand where R star, the neutral rate, is, right? I mean, people say, well, it's a little bit higher. I mean, can we put a figure on that? Does it matter?
Well, I think R star, or the long-run neutral rate, is actually a huge exercise in false precision. I think the neutral rate and R star, the amount of time that academics spend on this concept is really futile because it's a backwards-looking metric, right? It's similar to concepts like the Phillips curve, right? The Phillips curve we've been talking about for 70 years since its creation, but is there any future predictability in the Phillips curve or R star? It's all backwards-looking, right? It's like talking about price-earnings ratios.
So what do you look at?
So what we try to do is we try to decompose economic variables and try to understand how those correlations may be changing for the future. So if you believe that we're in a period now of deglobalization, and what does that mean? And how the demographics that were causing deflation the last 20 years are actually shifting now. And we're starting to see those same exact demographics turn to dissaving. As the baby boomers start to actually finally retire and spend their money or at least pass the money down to a younger generation, which has more of a propensity to spend, that has huge implications for how inflation is formed.
But so I mean, if you just take deglobalization, right, and if you assume that this fragmentation that we've seen continues, that actually there's much, that trade gets redrawn because of geopolitics, that's inflationary. We are also saying consumption, that's inflationary. So is there a risk that central banks can't cut?
Oh, absolutely. Absolutely.
Even the Fed? Do you think the Fed can actually raise at the next time?
Well, I do. I think that just 4 or 5 months ago, the markets were pricing in about 7 interest rate cuts for 2024, right? What's the reality? 0. And we think that it's unlikely that the Fed will be able to cut this year. And remember, we have a very significant presidential election coming up. And that does have policy implications. So I think once we get through all of this, it's pretty much a 50-50 bet whether it's going to be an ease or a hike at the next week.
What do you mean by policy implications? So actually what, depending on, because some of the policies are even more inflationary with the Republican administration?
Yeah, I think that actually with either administration, the policies will likely be inflationary. But I think if it is a new Trump administration, the likelihood of more fiscal and more pro-growth policies are going to be very, very likely pushing up inflation more. And obviously, tariffs. We don't know what's going to happen with tariff policy, but tariffs will be highly inflationary. So it's very hard for a central bank to really start to price that in to their forward policy reaction.
Richard, if you think 50-50, they could hike or actually they could lower interest rates, the Fed, how do you play the markets right now? Because that's a huge, I mean, that changes everything.
Right, well, it's very tricky. So I think we're at a natural stopping point right now, or a resting point in the market, where we're pricing in about 2 cuts for the rest of this year. But I think that's more of a mean probability. If you think about the reality, the market's probably pricing in about 1 cut and then pricing in some insurance that there might be an economic accident or a stock market accident. And that's the way markets have priced in sort of what we call the left tail risk for the last 2 decades. But I think it's really going to be dependent on data. It's going to be dependent on this presidential election. And I think you really have to be quite nimble in how you position yourself, but you also have to take everything from a bird's eye view. I think the market can get very micro-focused in the moment, and that narrative can shift very, very abruptly. And I think for the equity markets, the same thing. We've come a long way. I think that there's been a real secular movement of an underinvestment in the equity market since 2022 to everyone trying to get neutral again, and that's caused this rally. But now I think, you know, as interest rate policy becomes more and more uncertain, and obviously the geopolitical situation and the political situation becomes more uncertain, I think you just have to be much more nimble about how you view markets right now.
Richard, thanks so much for joining us. Great to have you, of course, on the calls. Richard Tang, Global Head of Markets at Rockall's Capital. Now, coming up, we'll have plenty more from Paris. Europe is in focus. We'll be speaking to the former MEP and former Deputy Governor of the Banque de France, Sylvie Goulard. That conversation is up next, and this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Welcome back, everyone. Now it's just 3 weeks until hundreds of millions of citizens across 27 nations head to the polls to elect a new European Parliament. Now, my next guest was Deputy Governor of Banque de France, also formerly a member of the European Parliament for West France, and briefly served as the nation's Armed Forces Minister. Sylvie Goulard, welcome to Bloomberg. I'm really delighted to speak to you because we were all watching news of this attempted assassination for the Prime Minister of Slovakia, something that Europe had not witnessed in over 2 decades. As a European, just as someone who believes in democracy and speaking amongst political markets, what does this tell us about the future of Europe?
Now, first of all, it's always very sad, and I hope the Prime Minister will recover. Second, I think we should all take a minute and think on where we are. We have a tendency to take Europe, the stability, the democracy, the rule of law for granted. It may not be the case. So this is what is at stake in the next European elections.
But are people desensitized to thoughts that held us together in the past? Do you see an electorate that wants something more? When people go and vote in Europe, do they vote for the carton of milk or do they vote for something else?
Well, what I fear, and it's deeply sad, is that we have separate national debates on Europe where national governments or opposition parties very often try to nationalize the topics. They talk about parochial issues, they talk against the government. Some parties try just to catch the anger. This is not what is at stake. What is at stake is the European election. It is a European-wide, and it's the election. It's the only part of the world where we vote in a transnational government. It is about the rules, the laws, saving democracy, answering to Putin and Russia. This is what is at stake. Don't let you be abused by people who want to make it national.
But you were Deputy Governor, of course, of Banque de France. Does it boil down to inflation at the end of the day in that booth? Are people just going to look at how economically they feel compared to last time they voted and vote on that basis?
Well, the reason why the treaties are very clear that we should fight against inflation is that inflation creates instability in the economy and politically. We see it in the US as well. It is not only in Europe. But I would quite say that, unfortunately, the debate is not on economics. It's about very phantasmagoric visions of identity, migration, and fear. Many people are making campaign on fear and hate. And this is the reason why all moderates should really mobilize themselves.
When did that start? And again, is it, you know, do we go to history and say, look, this is the template of what happened in the future? Was the movement started in a particular region? And how do you see it evolving in the next 2 years?
History in the sense that the generations who knew what Europe really was are leaving us. They are dying now. They are leaving the stage, and the young politicians are sometimes completely irresponsible. You can disagree with some rules, but to put into question the framework could have catastrophic consequences. The second reason is the social networks and the way algorithm puts people in bubbles. And the third one is, of course, that we had a migration wave and that all our societies are very schizophrenic. We need workforce. We perfectly know that without foreigners, we will not have restaurants, hospitals, works in our streets. And at the same time, some politicians try to put the blame on people coming from foreign countries.
I mean, you know, sources are telling us that the French president is trying also to have a change of president at the European Commission. Do people in France and elsewhere feel they're close enough to Europe? Again, Europe seems a little bit like the sick man in the world. You have China, you have the US firing on all cylinders, you have these fights, and Europe stuck a little bit in the middle.
Well, at the Bocconi University, we made a study with the Bertelsmann Stiftung showing that Ursula von der Leyen is much more known than any of her predecessors by the public at large. Second, I would say that we need to stick to the treaties. The treaties say that the European Council takes the candidate, the president of the Commission, in the family that arrives first in the elections. So there is a link between the election and the choice. As far as I know, Ursula von der Leyen is the candidate of the EPP. We will see, of course, what the result of the elections is. At this stage, I don't want to speculate. The key question is not only if one party is first. The key question is not to give the keys of Europe to the cuckoos, you know, these birds who want to put their eggs in the European Parliament without at all having any project, any sensible vision of the future.
But if people vote for them in mass, it means that there's something wrong with the system right now, that people feel unhappy. That's what democracy is about.
Yeah, but I'm not sure that they vote against Europe. I'm not sure. Some polls show that they would like more cooperation in defense, that they would like more security. The truth is that we have the wrong system to vote because we delegate to the member states at the national level the whole campaign and the way we choose. We don't have pan-European lists. When I was at the European Parliament, I was in favor of mixing the people in the list and Europeanizing the debate.
But this is, I mean, the rise of populism is something that's also at the sovereign level. So there's something wrong in the European dream and the American dream. Is that fair?
It is democracy. It is the case in the UK. We had Brexit. It was the result of anger. In the US, they had Trump. That was the result of anger. And in Europe, and we should listen carefully to what people are saying. For example, they want a fair transition. They are not against measures for climate change. They are against the fact that there is not enough fairness. And they express anger against Macron or against Meloni or against Scholz. It does not mean that Europe is always the problem.
Sylvie Goulard, thank you so much for joining us. That was the former MEP and former Deputy Governor of the Banque de France. We'll have plenty more, of course, from the JP Morgan conference throughout the day. This is Bloomberg.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Slovakia's Prime Minister Robert Fico is in serious but stable condition after an assassination attempt on Wednesday. Now, the country's interior minister says the shooting was politically motivated. For more on this, we're joined by Rosalind Matheson, Bloomberg's EMEA news director. Ross, frankly, this was shocking, and it was shocking for everyone in Europe. We haven't seen anything like this in at least 2 decades on European soil. Will it have an implication on European elections?
Well, it's interesting, the timing, obviously, because it comes shortly after the presidential election in Slovakia, and as Slovakia has become deeply polarized under the administration of Prime Minister Fico, very pro-Russia, anti the war in Ukraine, anti-EU, anti-NATO, anti-NGOs, anti-LGBTQ rights. And so there's real division that we're seeing in Slovakian society, but it's not Slovakia alone. As you say, we're coming up to the EU elections. The mood in Europe just feels very uneasy, very tense. I mean, there's the impact, obviously, again, of Russia's invasion of Ukraine. What does that mean for the rest of Europe with Putin on their doorstep? What are his longer-term intentions for Europe? What to do about Ukraine? But then you've also got the issues around the European economy. You've got issues around immigration that will feed into the EU election. You've got some governments with their liberal administrations pushing against, the independence of the courts, of the media, against LGBTQ rights. And all these things are becoming quite tense issues across Europe as a whole, in Eastern Europe certainly, but also even in countries like France and Germany. And so you've got parties on the far right, parties on the far left, a lot of people confused and divided in the middle, and really you're seeing parties play off those divisions, and we're seeing a lot of disinformation flowing as a result, and possibly the hand of Russia and others in all of that. So it's just a really tense environment, and obviously this shooting comes at a difficult time for Slovakia, but also those bigger questions for Europe as a whole.
Ross, very quickly, I mean, we always thought that this possible alliance between Russia and China was almost a marriage of convenience. But actually, we heard from President Xi that he wants this, sympathy to last for generations. What do you make of that?
Well, it's certainly seen by both sides as a long-term relationship that benefits both of them. I mean, it does ebb and flow a bit in terms of importance for each of them, but overall it's seen as, a buffer together against, the US, for example, against the West as a whole. So they're supporting each other economically, but also strategically, and it makes sense for both of them. And you can see from the language from this visit at the moment, from the Russian president to China, it suits them to do so.
Yeah. Ross, thanks so much, as always. Rosalind Matheson, Bloomberg's EMEA news director. Coming up, we go back to the markets and talk FX. This is Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices. They all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
This is Bloomberg.
Global stocks rally with the S&P 500 hitting another record high as cooler U.S. inflation reinforces bets on Fed rate cuts. Now, Slovakia's prime minister is in a serious condition after being shot in an assassination attempt, the first on a European leader in more than 2 decades. Plus, Xi Jinping tells Vladimir Putin that China-Russia ties should last generations as a Russian leader receives a red carpet treatment in Beijing. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in Paris at the JP Morgan Global Markets Conference. Now, signs of easing U.S. inflation boosted bets that the Fed will ease policy this year, causing the dollar to weaken broadly against its peers. Now, the yen was one of the biggest gaining currencies, though it's paired some of those moves since. Now, the yen moving further away from the zone that prompted suspected intervention in recent weeks. Joining us now is Mira Chandan, Global Co-Head of FX Strategy at JP Morgan. Mira, as always, thanks so much for joining us. I mean, you certainly had some pretty exciting moments. It has not been dull in FX. I think we can start there.
Definitely, yeah.
But in fact, a bit of a roller coaster. Like, what happens to dollar now?
I think, look, I mean, there's a medium-term issue, which is that the dollar should stay well supported because at the end of the day, even with the inflation outcome that we had, the Fed is still only going to be cutting twice, at best thrice this year. So if the dollar is still at close to 5% yields, that's still pretty attractive for the currency. But I think in the near term, there is certainly a pocket of weakness that's well within scope because I think the inflation number came as a bit of a relief. I don't think it changes the game narrative for the Fed, but
it doesn't. But the markets were like ran with it.
And I think the issue we've had and the concern we've had around bullish dollar view has basically been that investors have actually been quite long the dollar. So I mean, unlike in U.S. rates where positioning hasn't been that crowded, actually positioning in dollar length was quite crowded. So I am concerned near term that we see a bit of a fallout here. But I think come the June meeting, I think there's still a decent chance that the Fed could sort of, because they still haven't internalized this last 3 months of inflation data. It's going to be to the upside, but I think there is a bit of a pocket of weakness here in the dollar.
But I guess, I mean, dollar strength was a problem for many countries, right? And it was the first time, certainly, that I remember the Treasury Secretary kind of acknowledging, I don't know if she was giving the blessing for intervention from certain emerging economies, but she certainly maybe wasn't as robust in the past in trying to push back against it.
Well, I think the U.S. and also they issued that joint statement with Japan and Korea a few weeks ago, and I think it's all a part of, the strong dollar is not really a U.S. problem. It's a problem for the Asian currencies, and I think it was a green light for them to say, okay, you can intervene if you want, and I think the Ministry of Finance in Japan certainly did that. The Asian currencies have been doing it. Central banks have been doing it in any case, but this does take the pressure off of them. I mean, if U.S. yields are lower and and the pressure is off the Fed, equally it's off Asian central banks. So hopefully they'll have less of a need to do it. Dollar yen in the mid 150s, though. I mean, if the Fed is still at 5% at the end of the year, I think we would be testing 160 again in dollar yen for sure, because BOJ is just way too dovish compared to the Fed.
I mean, how much more can they intervene? And again, it's interesting that they were kind of very tentative in just coming out to the markets and saying, guys, that was one of our operations.
Yeah, they did $55 billion already in that first week, and I think they know that at the end of the day, the The reason why this yen weakening is happening is because of fundamentals. So it's because the BOJ policy is way too easy compared to the Fed. And if they don't fix that, they can't really fix the yen weakness. So I don't think intervention is the solution here. So they can throw a bit more money at the problem. This is not going to change the narrative. It's going to come down to, will the BOJ have the ability to raise rates, which I think is harder because it is an indebted nation. The government's highly indebted, and they've just used to low rates. So they don't want to rush into hiking rates too quickly, otherwise, something might break.
But do they just need to go at some point? I mean, inflation, again, for them is in the right direction.
Well, inflation has been in the right direction. They've just not moved, and the market's latched onto that because even, you might say your policy is unchanged, but actually if inflation's gotten higher, your real yields become more negative, and you haven't really caught up to that reality. But I think they're going to hike a couple more times this year. We think a total of 50 basis points in the second half. But if the Fed's at 5, it's not going to make a difference. So I do think that the market's going to be testing them on dollar-yen higher once again.
Samir, in terms of pairing for the yen, do you go dollar-yen or euro-yen? Because that's also quite an interesting play, right?
Yeah, definitely. I mean, dollar-yen, I think, is certainly the more divergent view because unlike the Fed, the ECB is actually going to start cutting in June. But even with euro, I think what we have to keep in mind is European growth is now improving. It's a very different situation if the ECB is cutting because we're heading into a recession in the Eurozone, but that's not the case. They're actually cutting despite decent growth because inflation is coming off, and I think that's actually can be, in certain instances, euro positive, certainly should be euro positive versus yen. So to me, it would be actually a higher conviction move to say dollar-yen probably higher, because the Fed's actually inactive. So dollar-yen is more relevant than euro-yen.
I mean, we're quite in a quirky year, right, where the ECB and the BOE move before the Fed.
It doesn't happen. It hasn't happened. It's the first time since the inception of the Eurozone in '99 that the ECB is going to be cutting before the Fed. And in fact, I would go on to say that by June, 45% of global central banks would have already cut before the Fed. And again, if you go back last few cutting cycles, that doesn't happen again. So, in fact, emerging markets is leading the way higher compared to the Fed, lower compared to the Fed, and actually ECB, very unusual for the ECB to be doing that, but that's what's happening.
But so what does it tell us? I mean, again, this is a cycle like we've never seen before, right? Yeah. So we don't really have a textbook on this.
Yeah, it tells us, I think, that the Fed cut by itself is not going to be enough to get you that massive dollar weakness, right? Because the Fed's not the only game in town. In fact, as far as the cutting cycle goes, they're probably one of the last games in town. So it just means the dollar maintains its yield advantage, and I think it would be a mistake to look at the Fed easing and say, oh, this is enough to get us dollar weakness, because actually, if half of central banks have already cut before, it's not going to matter. So I think this means that despite a cutting cycle from the U.S., actually the dollar can stay pretty strong in that environment.
How do you look at renminbi? I don't know whether it's kind of in the focus, but we're still trying to figure out exactly what happens to China in terms of what kind of package they can do to support the economy and how much they contribute to the rest of the world. Is it a good story for you?
Well, again, I think everything's coming together because you've got a soft U.S., softer or not as high an inflation print in the U.S., you've got European growth improving, and you've got now China stability measures coming into play. I think it remains to be seen to what extent this is going to be having an impact on the currency. But I would say that it's not going to be as commodity intensive. Any support package is not going to be as commodity intensive as it has been in the past. So just because there's some additional support pressures doesn't automatically make it good for commodity currencies, and it doesn't automatically make it dollar negative. So I think it's yet another signal of hope for global growth, but this is going to be a long, drawn-out problem. It's not.
If we see retaliation from China on some of the tariffs that the U.S. put, does it automatically benefit some of the neighboring countries as the trade routes are redrawn, or again, does that take time and a lot of it have already been done?
Well, the Biden tariffs are pretty limited in scope. It's a small number compared to the entire trade surplus that China has with the U.S. If that expands out, that could be more meaningful, but it is a growth hit. to China, if all else equals, it is a growth hit, which usually equates to weaker currency. So I think, and then obviously, as we know, Asia has been under pressure in general in any case because of what's going on in Japan and what's going on with US yields. So I think it actually puts more pressure on Asian currencies. Any trade conflict will make the Asian currencies more vulnerable. And I think that's the angle that I would focus on rather than this being a boost for commodities, because I don't think that translates.
Mira, thank you so much, as always, for joining us. Mira Chandan, their global co-head of FX strategy at JP Morgan. Now, a reminder that at 1:15 p.m. London time, 2:15 Paris, we'll also be speaking to the JP Morgan Chief Executive, Jamie Dimon. So don't miss that interview. Coming up, our exclusive conversation with the chairman of the European Banking Authority. He's José Manuel Campa. We'll discuss commercial real estate, private equity, and maybe, just maybe, we'll talk about consolidation of European banks. That's next, and this is Bloomberg.
The names that move markets are on Bloomberg.
How worried are you about the U.S. election? It's for the American people to decide what they want with their politics, with their government, with their future. But obviously, we are all concerned about it because the United States is the largest economy, the largest defense country in the world, and has been a beacon of democracy with all its upside and downside. We cannot interfere with their choice. It's their choice, and that's the beauty of democracy. But we have to be extremely attentive and anticipate, just as we do with inflation. You know, we do scenarios. What if, what if, what if? Then what do we do? Where I sit now in Frankfurt, head of the ECB, I think that we have to be strong as Europeans and not assume that we can rely on whoever our friends are around the world, because these things change over the course of time, as we have seen.
Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
The biggest problem is that racism and extremism is really having a huge impact on the long run on our democratic systems. It creates a system of fear. They give simple answers to complicated questions. They never work. So, at the same time, this is the biggest fear, that we need immigration. We need to have an open culture of integrating different cultures and diversity.
Now, that was a Siemens chief executive, Roland Busch, on his calls for more immigration and tolerance in Germany. Now, that full interview available on the Bloomberg terminal and on our website, where he also discusses why China's weakness is weighing on the German manufacturing. Now, let's talk about some of the concerns, and let's stick with Germany. The country's banks have seen a jump in customers struggling to pay back commercial property loans in the fourth quarter. Now, the sector is still adjusting to higher interest rates and changes in consumer behavior after the pandemic. Well, let's discuss all of this with the chairman of the European Banking Authority. He's José Manuel Campa. He joins us exclusively from Paris. Mr. Campa, thank you so much for joining us. I mean, as far as I can remember, which is 12 months, we've talked about commercial real estate as needing to adjust to these environment of higher interest rates, about something going wrong, about this being unsettled. Is it going to take longer for all of this to shake out?
Well, I think, as you said, we've been talking about it already for almost a year,
but I think we're likely to talk about it more over the long term, because at the end it's really a structural change that's taking place. After COVID, we know that people are engaging in working activities in a very different manner, and that affects commercial real estate activities across the board. Commercial real estate is very broad in content. It includes many different things, but I think it's an adjustment that's taking place over time, probably affecting more some of the pure home office buildings in city centers that are very financially or office-oriented, but we will see that evolving over time. We monitor that carefully.
When you say over time, I mean, do you see a point where there's just distress because this catches up and they have to refinance and reload? Or do you think this is being managed as some of the big companies, for example, sell off their portfolios and refinance gradually?
I think it's being managed, but I think at the same time, when we look at the type of loans that many commercial real estate firms, they tend to be what we call bullet loans, which is when all the principal gets repaid at the end of the life of the loan. So that basically requires either an ability to refinance or a lot of cash at that point to be able to pay back that loan. And that's a situation that needs to be managed carefully, So that may lead to some situations of potential distress. As we look overall, the banking sector, the overall exposure of European banks to commercial real estate is not that large. It's in the range of 10% of their loan book. But that's, of course, is an average across the Euro region.
Is there anything that you worry about banks right now? I know, in the past it's been concerns about liquidity. I don't know whether there's quite a lot of market volatility, although markets seem to be, behind some encouraging news of late because of the Fed. But what worries you the most about the sector right now?
Well, as you say, how the interest rate environment is going to evolve and develop over time, it's always a source of concern, And so far, the central banks have been able to keep interest rates up without really damaging either the financial sector or the real side of the economy. And employment's performing very well in the major economies, so that's all good news for credit quality and for banks overall as assessment of credit risk. So in that sense, so far so good. As we go forward, I think that beyond the interest rates, there's the whole macroeconomic uncertainty on geopolitical terms. I think that's a big source of concern for us. That has different ramifications. Within those, I would like to highlight two. One is potential cyber risk, cyber attacks, cyber tensions. That's an area of vulnerability. Second one, potential fragmentation, more structural over the long term.
Mr. Camp, I mean, there's also, I'm sure you've been kept busy by some consolidation efforts, first of all, domestically, Sabadell and BBVA. Do you think there will be that kind of consolidation? Is it healthy? Is it important to have it? And does it have to be non-hostile for the cross-border consolidation to arrive?
Well, we've been very keen for many years on the idea that we think that consolidation in Europe will be a good strategy of the banks, But at the same time, I always say that the goal is not consolidation per se. The goal is to put forward on the consolidated a stronger business case and business model than of the entities that were working before in a separate manner. So that's very important. What's the underlying business structure? As a European authority responsible for deepening the single market in Europe, I'm very keen on fostering cross-border consolidation in Europe. That has not happened so far. So I hope the economics, now that the interest rate environment is more healthy, that the economics will work for the banks to push on that consolidation. And as I said, that is what I like to say, constructive destruction, so that the good ones are able to increase their market share, increase their activity, the well-managed banks, the not so well-managed banks, they're orderly leaving the market.
But why haven't we had any so far? I know that, a lot of say, well, the regulators have been pushing back. Our editor-in-chief spoke to President Macron on Monday, and he was also open to this idea that a French bank could be taken over. I mean, when it comes to, seeing it on paper, is that really true?
Well, I was actually, to be honest, very, very, very happy to hear the remarks by President Macron. I think those go in the right direction, that what matters is the single market at the European level. We need to think more of European interests in an effective market rather than individual national interests, because we have seen consolidation over the last decade, but has been mainly happening at the local markets within national boundaries in the European Union. So what will be good is having cross-border. Now, the economics for cross-border consolidation, the banks, when I talk to banks executives, they see more challenges. They see more challenges because they think it's different. It's more difficult when you think about the gains from that consolidation arising from cost reductions. There's less overlapping of branch networks. That's more difficult to consolidate. Also, back office of operations, some of the headquarters within, if they're across different countries. All that are issues that we need to try to address.
But is Spain overbanked? To you, does it make sense, BBVA Sabadell?
Well, I don't know. That's for them to decide whether it makes sense or not. I think that overall, there's evidence that there's a lot of banks in Europe, over 4,500. Spain particularly, actually, it's been already a fair amount of consolidation. So at the national level, it's one of the countries that has the highest level of concentration of banking activity. But when I think about wider in Europe, I think consolidation is good. One thing that I like a lot about the consolidation that has taken place in Spain is that it has been a consolidation that has created stronger banks overall. So the way I like to say, the good ones won, and that's something that you like to see.
Talk to me a little bit about consumer loans. I mean, again, there's this idea that actually we're okay, that consumers are okay. Do you see any stress in some of the figures that banks are showing up? Or is there a danger that it's not the banks that sees something bad happening first?
Well, exactly. On consumer loan, what happens first, the prevalence of consumer lending in Europe relative to other economies is much lower. It's much lower. Having said that, there's been always an area of vulnerability on consumer loans, which tend to be the lower income, more vulnerable individuals that maybe they're not able, they don't have access to a type of loan, and they get credit card loans or auto loans in a very demanding terms, and as the interest rates rise, that may put pressure on them, and they're by definition the most vulnerable. So that's an area of concern. I would not say that that's a concern for financial stability or a concern for the solvency overall of the banking sector, but it's a concern for certain groups that are vulnerable in society.
So good to speak to you. Thank you so much for joining us. That was Jose Manuel Campa, the chairman of the European Banking Authority. Now, we'll have plenty more, of course, throughout the day on some of the markets that we're seeing also coming up. Roaring Kitty goes quiet. Yes, so this is a meme stock rally. It's been fizzling with GameStop shares taking a tumble. So we'll talk about meme stocks next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. To the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back, everyone. Now you're watching live pictures from day 3 of the Qatar Economic Forum in Doha. Bloomberg's Romana Bertseche hosting a panel called Venturing into Disruption about how venture capital is raised. Now, speakers include the founders of companies like Alphawave, WonderCo, Golden Gate Ventures, and Global Ventures. Now, take a listen.
Advantage because you're starting with them from very early on.
Well, I don't think there's a right or a wrong. These are, just, I think different expertise that you develop. I think what's particularly exciting for the WonderCo team is finding those great entrepreneurs with great ideas early enough to really be able to bring value to them. I know everybody talks about that. Starting a company 0 to 1, I like to think is impossible, and 1 to 10 is improbable. And so getting on the journey, with young entrepreneurs and companies that have already achieved that 0 to 1, and where
well, of course, you can follow that. Our coverage continues on T-Live on your Bloomberg terminal. Now, the meme stock rally, of course, has faltered with a chunk of the $11 billion in gains made by GameStop and AMC Entertainment wiped out yesterday. Now, the stocks more than doubled after the return of social media posts by Keith Gill, better known as Roaring Kitty. What a name. Now let's get more from Bloomberg's Charlie Wells. So, Charlie, good morning. What drove and is now sputtering this rally?
Francine, I think it comes down to a pretty simple thing, and it's that Wall Street has wised up to Wall Street bets. So professional traders now know when to get into these meme names like AMC, like GameStop, but they also know when to get out. And I think that's changed significantly, especially from 2021 when we were in the thick of that meme rally. I covered that, and it was incredibly exciting, but I think what is different, of course, is the economic situation that we're in right now, too. And I think that's why this was somewhat surprising, that interest rates are a lot higher, but you're still seeing this kind of activity. And so, something else that's different is there seemed to be some short interest, but less short interest than in 2021. And that looks like it's not going to keep this rally going, as long as some people may have expected.
So, Charlie, is there a consumer read-through that we get from this week's meme boomlet?
Well, this is in a lot of ways why we care about meme stocks, because, at least in some parts, they reflect the retail trader. They reflect the retail trader who is a consumer. And I think there's an interesting story here about a consumer who feels comfortable making some of these speculative plays at a time when overall consumer sentiment has been pretty negative. And so I think there's a story you could tell that, maybe that behavior is better than what consumers have been saying. But I think that really kind of hinges on how much of this activity was the retail trader and how much of it was that wised-up Wall Street professional.
So, Charlie, really quickly, shifting from small-scale traders to big players, major investors have been revealing their holdings in 13F filings. What have we learned?
Yeah, best thing to come out of this was we finally got an answer to what Berkshire Hathaway has been doing. They've been allowed to keep some of their holdings anonymous from the SEC. That is allowed. But what we found out in these 13F filings is that Berkshire Hathaway has taken a $6.7 billion stake in Chubb. That is one of the largest insurers in the United States. They also operate in 54 countries. No surprise that Berkshire Hathaway interested in insurance.
Charlie, thanks so much. Charlie Wells there with the very latest. Now, another reminder, we have Jamie Dimon, 1:15 p.m. London time. This is Bloomberg.
Let's suppose you're on a plane and somebody realizes who you are. They say, I have $100,000. I don't know what to do with it. Where should I invest it? Where should they put their money?
So today, it's a easier decision than it was maybe 2 years ago because Treasury bills are 5%. So I would say, regardless of how much risk you want to take, you have to put a portion there. Then you would have to ask, really, an individual is the same, I think, as any institution. What is your time frame? Do you need to get access to this $100,000 in the next few weeks, the next few months, the next few years, not until you retire? And that will determine your investment decision.
So what do you think is the most common mistake investors make when they have 100,000, $1 million, or whatever they might have? What is the most common mistake you have observed that investors make?
I would say hubris and thinking you know more than you do, because every decision that you make has many, many layers. So as you're creating a portfolio, look at the risk as well, not just excited about the return.
And what's the best investment advice anybody's ever given to you?
Continue to learn about innovation in whatever you do, because that is where it's not exciting, that's where returns will go.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and
beyond. Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
Good morning from our global headquarters in New York. I'm Manus Cranny. Welcome to Bloomberg Brief. Let's set your agenda. Risk on unleashed as cooler U.S. inflation reinforces Fed rate cuts as soon as September. Big money bets. Buffett's Berkshire reveals his stake in the insurer Chubb. Michael Burry doubles down on China tech. And we get a fresh read on the consumer and the global economy when Walmart and Deere report their results before the bell. More on the U.S. consumer in just a few hours. But this is about a roaring risk rally right the way across the risk spectrum, so much so that you've got BMO talking about stocks hitting 5,600. Just a couple of months ago, they were talking 5,100. BMO ups the game to 5,600. We are underassuming the level of growth out there. Some other lovely reveals in the 13. Where Warren goes, we all follow Chubb. Up almost at the moment, let's just see, up nearly 9.5%. As we understand, Berkshire Hathaway has a position in that. And then at the same time, Michael Burry talks about what he's doing with JD.com and Alibaba. But Cisco upping the guidance. So Cisco nicely bid this morning as well. Bottom of your screen, up 4.5%. Now, bang for your CPI buck. On a hot print on CPI, the bond market ratcheted by 18 basis points. On a better than expected CPI print, we came down by 10. So the market is beginning to settle here. We're going to catch up with BlackRock in a little while. They say you want to stay at the short end of the curve because for tens at the bottom of your screen right now, will have the potential to retest that 5% level. But literally, it was unleash the hounds or unleash the bulls, whatever way you want to talk about it. Now we must debate the cadence of the cuts. It is not 2008. It is not 2019, which was 3. The yield gap closes, the potential yield gap closes between the Fed and the ECB, and that invigorates the euro and leaves the dollar offered. So what exactly are traders growing more confident of? Well, that the Fed will cut their interest rates this year as a result of that drop in the CPI. The Minneapolis Fed President Neil Kashkari spoke about what it might mean for the central bank.
How much downward pressure is monetary policy putting on the economy? That's an unknown. We don't know for sure. And that tells me we probably need to sit here for a while longer until we figure out where underlying inflation is headed before we jump to any conclusions.
So a often used refrain, we're going to have to sit here for a while, we need a little bit more confidence. Bilal Hafiz is the CEO of Macro Hive, joins me now. So Bilal, I looked through the body context of what he said. He's talking about the biggest uncertainty is the pressure on the economy. We can debate about the wealth gap and where that pressure comes to bear in a moment. But for a while longer, what does that mean? The market is saying September. Does that rhyme and chime for you? September live and a 25 basis point cut then?
I mean, my bias overall is actually not for a September cut. Instead, I think the risk is that we don't see any cuts this year. So I think yesterday's data, while it has pulled forward rate cuts, I think the market is overestimating the possibility of cuts. I do think that the US economy remains strong overall. I do think there also is persistent inflation, especially in the services sector. So I think the market's getting a bit ahead of itself, and my bias at this stage, at least, is not to expect a cut in September.
And it's interesting, I started the show by saying, you know, bang for your better than expected buck in the bond market. In other words, we came down by 10 basis points. And yet when we got the hotter print, it ratcheted by 16, 17 basis points at one juncture. So there is this reaction function to incrementally better news relative to bearish news. Is the CPI as credible? UBS were with me yesterday saying owner's equivalent rent is nothing more than a fantasy. So really, how much credibility does CPI have in terms of the bleed through to PCE?
Well, there is a widening gap between CPI and then also PCE. But in general, I think what you have to do is you have to look across a number of different inflation metrics to get a true sense. It is true that the OER measure is in the end some kind of weird moving average over 12 months. And in reality, if you look at other measures or surveys of, say, consumer confidence and such, most people on the street are still feeling inflationary pressures are very, very strong. So overall, that tells us that there are still inflation problems across the economy at the moment.
So here's the debate, and Andrew Bailey encapsulated it beautifully for me, so much so that I'll use it 3 times. If it's good, overuse it, I say. It is not 1998. It is not 2001. It's not even 2019. So what is the cadence that we can expect here in terms of we are going into somewhat of an unknown, a fairly strong US economy without an exogenous shock at the moment? And I emphasize the word at the moment because typically macro policy is only provoked or irritated into real movement by a dramatic exogenous shock. So what kind of cadence can you really look at if we're underestimating the solidity of the US economy?
Yes, absolutely. I mean, I think it's hard to draw parallels to the recent past, so recent being the last 20 or 30 years, because we've been in this environment, at least since the mid-1980s, of declining inflation driven by globalization and all those sorts of factors. And since COVID, we've had a fundamental regime change, and everyone's trying to grapple around, is this a genuine regime change, or are we going to revert back to what we had before COVID? My sense is this is a regime change, so the cadence has changed, and there are important structural forces. One example is deglobalization, which is popularized by the clash between US and China, which is going to lead to higher inflation. And the other is, if you listen to central banks, frankly, they don't know what is causing inflation. They don't know how their monetary policy is affecting inflation as well. And that high level of uncertainty tells us that nobody really knows, what's going to happen in the future, nor do they know how to calibrate policy in the right way. So all of that tells me that we're going to end up with an outcome that nobody likes.
Well, we have a bifurcation in where policy is restrictive, don't we? This plays to what Paul Donovan said yesterday, which is, lower class, blue-collar workers are having a tougher time in a 5% high inflation, grocery store, gasoline, living costs. They are materially biting. We're spending less at Walmart, at Starbucks, and those kind of companies. We're becoming more judicious. But the middle class, those people with savings and house and home equity, is indeed weathering this very well. And this is where the transmission mechanism of monetary policy is ultimately bifurcated.
That's correct, and that's been one of the key features of what we've seen over the last few years, because people have locked in low mortgage rates, out to 30 years, that homeowners have not been affected by the increase in interest rates that the Fed has engaged in, whereas people at the lower income bracket, where they don't own their houses, instead they have to pay higher rents, they've been affected by high interest rates, which feed through to higher rents. So indeed, there is this bifurcation. And on top of that, in the US in particular, there's been a surge in immigration as well. So there's been this influx of additional workers into the US economy, which has pushed up rents and other such parts of the market. So there's all these new dynamics that we've seen over the past few years. And in the end, this does put more pressure on the income inequality dynamic that you're seeing in the US, but equally across the developed world.
It's interesting, but just looking at what Torsten Slok sent through from Apollo, of course, he's saying no rate cuts this year, but he talks about the very essence of wealth, which is about how U.S. homeowners, in terms of their expectations, their wealth, as it were. This is household expectations to house price appreciation. It's the highest since 2007. And this is the very essence of strength in the consumer in the United States, isn't it?
Yeah, and I would say there's two things related to that. One is that people's implied wealth has gone up a huge amount because house prices have gone up. And then the other side is, on the liability side, the value of their debt has gone down in some ways because they've borrowed at low interest rates, and interest rates have gone up elsewhere. And so in some ways, their borrowing has, from a wealth perspective, gone down. So from a net asset perspective, they've benefited both from the asset side and the liability side, which gives them a big benefit.
Bilal, great to have you with us on the reaction function. The bond market seems to have voted with its feet for the moment, but let's see whether that carries through. Bilal Hafiz of Macro Hive. Other stories trending on your Bloomberg terminal this Thursday morning. Cisco, as I said, she climbs in the pre-market after giving a solid sales guidance and profit forecast for the current quarter. The CEO, Chuck Robbins, is continuing his push to remake Cisco as a provider of networking services and software, a strategy that included a $28 billion acquisition of Splunk. Now, the shift still hasn't fully insulated the company from fluctuations in hardware purchases by corporate and telecom customers. Warren Buffett's Berkshire Hathaway unveiled a $6.7 billion stake in the insurer Chubb. The disclosure ends months of suspense over its mystery position in a financial firm. Chubb shares continue to gain in pre-market. Separately, you had a quarterly filing showing that the Saudi Sovereign Wealth Fund had roughly halved its direct holdings in U.S. stocks. That was at the end of the first quarter, to a market value of around $18 billion. They'd replaced those with call options, so still maintaining exposure. We'll bring you the other highlights of the 13F filings a little bit later this hour with Sonali Basak. And Slovakia's Prime Minister Robert Fico has suffered life-threatening injuries after being shot in public. It's the first assassination attempt on a European leader in more than 2 decades. The 59-year-old was in hospital in a very serious condition following the attack by a gunman, who police say had a clear political motivation. Fico returned to power last year as a force of opposition to EU institutions in Brussels. The US says it's accelerating arms supplies to Ukraine as the country's military confronts the Russian assault in the northeast. Russian troops are pushing deeper into Kharkiv region, taking control of some villages close to the border. The offensive stretch in Ukraine's forces may push Kyiv to redeploy its units to the front line in the east. Well, coming up, the Russian leader, Vladimir Putin, visits China, drumming up further support for the war in Ukraine. We'll have more on Putin's meeting with Xi. That's next. And later today, don't miss our interview with the JP Morgan CEO, Jamie Dimon, 8:15 a.m. Eastern Time. Context matters on Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's Bloomberg Brief. I'm Manus Granny in New York. The Russian President Vladimir Putin met the Chinese leader Xi Jinping in Beijing for the first time in his new term. The meeting comes as Russian forces press forward with the new offensive in Ukraine.
China and Russia agreed that a political solution to the Ukraine crisis is the right direction. China's stance on this is consistent and clear.
For more on that meeting, let's bring in Bobby Ghosh. He's at the Qatar Economic Forum. The region that you're sitting in has very close relationships with China, Bobby. This is Putin's first trip in his new term, and I like how Bloomberg has phrased it. It's creating this crusher relationship. Your take on the meeting and how they extolled one another's commitment to one another?
Well, in a previous meeting, they talked about a no-limits friendship between the two countries. This time, they took it one step farther and said this was a friendship that would last for generations. This would be music to Putin's ears. He's there as the supplicant, as the junior partner in this relationship, and he's looking for reassurance from Xi Jinping that Beijing's support for Moscow remains firm. And at least in terms of rhetoric, he got that. Trade relations between the two countries, very strong. It has softened recently because Chinese companies are getting nervous about American threats of retaliation for those who trade with Russia. So Putin was looking for ways to overcome that. There's some talk of new banking deals. We haven't heard the details, but some talk of new banking deals that would make that trade easier, that would insulate that trade from international sanctions. But as I say, we haven't yet seen the proof of the pudding. This is mostly about optics. This is mostly about Xi Jinping telling Putin, you're still my guy. And that's exactly what Putin needs to hear.
What does that mean for the world that you're sitting in today, which is the world is trying to find off-ramps on the Gaza Israel conflict, and also in terms of the position of China's influence on Putin in Ukraine? Is that theater or real, or how does the world view Xi's role as a conduit to Putin?
Well, as you say, I'm in the heart of the Middle East here. And a lot of attention is focused on Gaza, on that particular conflict. But this is an economic forum, so a lot of people are also talking about the Cold War between the United States and China and how they are caught in the middle. Just like Russia, they too have to negotiate this Cold War. They too need to figure out how they do deals with companies in China? How do they do business with China? What happens if those businesses come under US sanctions for activities elsewhere in the world? Russia, for instance. These are very treacherous waters for companies everywhere to have to navigate. And folks here have expressed that concern to me over and over again.
Okay, Bobby, well done. Great work by you and the team at the Qatar Economic Forum this year. Some great content. Bobby Ghosh reporting from Doha. We've been talking about the 13F filings. This is just a small representation for you. Michael Berry of Cyan, of course, upping his bets on some of the China names on JD and Alibaba. JD.com, it actually overtakes Alibaba as their top holding. They boosted their JD position by 80%. We'll talk to Shanali more about that. That's really doubling down. And NVIDIA is there because the hedge funds, well, here's the shocking headline. The hedge funds up their gear on NVIDIA. And they cut to AMD. We'll talk more about what's driving some of those movements with Shanali a little bit later on. Now, the meme stock rally, it's just fizzling out, isn't it? AMC, both down by double digits, along with GameStop. We'll talk to you about meme stocks in just a moment.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us. Brief. I'm Manus Cranny in New York. What's making the front pages around the world? Let me just tell you. First up, we've got the Wall Street Journal focusing in on Microsoft. We understand 700 to 800 of their China-based cloud computing staff and AI employees, they were offered or asked to consider relocation. They could move to the US, Ireland, Australia, and New Zealand. And you've got this tension between Washington and Beijing mounting, certainly on the technology front. That certainly was apparent as we just discussed there with Bobby Ghosh. In terms of the Cold
war. Well, the U.S. Bureau of Labor Statistics, they published the CPI 30 minutes early. Did you see it? Did you find it? Full investigation is underway. No obvious signs of the early publication actually moved markets. IB me, let me know. Did you have the leg up? And the LA Times talks about Tesla and the context. More than 601 jobs in San Francisco and the Bay Area have gone. This is going to be the 5th week of layoffs at Tesla. And Musk had announced in early April that the company was laying off 10% of its global workforce. So let's focus in on the markets. We've covered it all week. The meme stock frenzy. GameStop and AMC double-digit drops pre-market this morning. Is the meme stock rally fizzling? Well, the Marathon Asset Management CEO Bruce Richards says he's been chasing in. Take a listen.
What's the big lean in? You know, you got to look at Keith Gill and you got to look at the Roaring Kitty. We've been leaning into, say, AMC. So we're long AMC for like a year, 2 years, 3 years. And when you lean in and AMC goes running up, there's a lot of equity that the company can now raise, and that goes right into our pocket because we're earning 15%. Senior secured, leaned up against all their assets.
And they already did that.
We're debt with debt protection, and we're earning 15%, thanks to Roaring Kitty and all the meme fan club that's buying up AMC.
So the debt issuance that we had announced yesterday by AMC, you think we're going to see more of that from some of these other stocks?
Absolutely. When you raise equity, you raise that, and it's a combo platter trade. And we're long, kind of the senior secured stuff that we bought in the 60s, that went to 70s, the 80s. They're now in the 90s, but we love them still in the 90s because we're earning 15% yield on that at a discount with all that equity cap that backs it now, and in a senior secured position.
Everybody's a winner, at least until the moment it turns. Marathon's Bruce Richard there. Speaking to Bloomberg, well, Charlie Wells is with me now. I mean, you're looking at, what is it, $11 billion, Johnny was just looking at the number in the story. $11 billion in equity value for both these stocks. It's turned around. What's causing the exhaustion?
I mean, look, man, is this is it? I think that's the question that a lot of people have. I think, early this week, there had been this expectation that maybe this meme rally would continue. But look, there's much more sophisticated actors now getting into meme stocks than were in, of course, 2021. We just heard an interview with someone who's a much more sophisticated investor. And in a lot of ways, this is kind of a momentum play. I've been talking with a lot of professional traders this week about meme stocks. And what they told me was that they saw options activity picking up last week. And then, of course, we had that tweet from Roaring Kitty, which just sent prices into overdrive. But with more sophistication comes also a better sense of when to get out. And it's looking like people are doing that now.
Well, sophistication or fear? Fear by Wall Street, actually, that the game is up and actually that the retail can roll back and bite them on the proverbial. So is it over? I mean, is this a short, sharp burst of Roaring Kitty roaring back to life and docility is the future?
I think what you said there is, kind of a meow this week. And, short and sharp, I think, is the way to think about this. I mean, structurally, we are just in a much different environment than we were in 2021. I mean, look at interest rates, right? I mean, that's one of the huge differentials there. But I think something that's important, though, is social media investing is here to stay. And so if this rally does not continue, that's that. But we're likely to see these sorts of bursts, these meows in the future.
Ah, good man. You got a nice little pun in there. I hadn't thought about that, Charlie. Wow. Okay, Charlie Wells on the meme stock and getting his own little pun in. Quick snapshot of bonds. It's the market that counts. This is the global bond market. Of course, pretty significant moves yesterday in 10-year government bond yields, both at the short and the long end. My next guest, of course, from BlackRock says you want to probably be at the shorter end of the curve because 10-year government bond yields could indeed retest 5%. What could urge it to be there? We'll ask that question on Bloomberg.
October of 2019, you surprised the business world by stepping down as the CEO of SAP, a very, very large company whose value had more than doubled during your co-CEO position and CEO position. And you took a position with a much smaller, less known company, ServiceNow. Usually people, when they leave a job, they go to a bigger company. Why did you go to a smaller company?
Well, I saw the future and where it was going. First of all, I want to say I had a great run at SAP, and it was a pleasure taking them from 39 billion to 163 and really inspiring lots of people and customers, and it was a wonderful experience. But after 17 years, nearly 10 as CEO, I was ready to do something different. And when I saw ServiceNow in the marketplace, I knew what it was, and I knew what it could do. And I knew with my background, I was a pretty good cultural fit for what ServiceNow needed to scale it.
So let me ask you, what does ServiceNow really do? Tell me in simple English language that everybody can understand. What do they actually do?
40% of the CEOs say today, if I don't digitize my operations, my company will no longer be viable in less than a decade. So we were the IT backbone for companies all over the world. How do they manage their assets, run their operations, secure their operations, all things digital having to do with IT.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Global headquarters in New York. I'm Manus Cranny. Let's set your agenda. Risk on unleashed as cooler U.S. inflation reinforces Fed rate cuts as soon as September. Big money bets. Buffett's Berkshire reveals a stake in the insurer Chubb. Michael Burry doubles down on China tech. And we get a fresh read on the consumer and the global economy. Walmart and Deere report results before the bell. A very good morning. So for a better than expected CPI print, you were rewarded. You were rewarded with a risk-on momentum from bonds to equities. The bond market at the short and the long end moved by 9-10 basis points. The last time, however, you got an unfavorable CPI print, this bond market moved by 18 basis points. Whatever way you look at it, we now must debate whether the 3-month hump in CPI has passed, and is the roadmap clear to cuts. How clear is that, and what cadence will those cuts be? Records in the equity market were abound. You had BMO upping the game to 5,600 from their target just a couple of months ago, 5,100. At the bottom of your screen, you can see Chubb up 9.66%. Buffett's Berkshire reveals their holding there. They've been given permission to not reveal that for quite a while. And Michael Burry ups the game on JD and Alibaba. More on that with Shanali in a moment. Cisco also bid up this morning ahead of the market. They're raising the full year guidance. And I suppose it's a bit of a relief in the euro that the gap between the US and the ECB may be narrower, and that gave the euro a little bit of a bid yesterday. We're down 1/8 of 1% this morning. So the Treasury rally after the CPI report. 10 years fell as much as 10 basis points, as I said to you. And bond volatility, this is the key for fund managers. They've got to overhaul their trading strategies, with bond mutual funds flipping treasuries at a ratio of 49% higher relative to 2022, making buy and hold investors turn into traders. Vasiliki Pachatoridi joins me now, head of EMEA iShares fixed income strategy at BlackRock. Good to see you this morning. I'm curious to know, I mean, the mutual funds flipping into traders, but if you were a buy and hold, if you held treasuries from the start of the year, you lost 2%. The quant funds made 5%. Do we need to be more nimble? Are you being more nimble? Are you being more dexterous and perhaps being pushed into more of a, not flip mode, but a more active engagement mode in the bond market? Good morning.
Good morning, Manus. Thank you for having me on the show. That is a great question, but let's start thinking about the investor. And I think it's good news for the investor. I would say people should just embrace the pause right now. Investors should continue clipping in that yield from quality bonds, but to your point, they should be actively looking for opportunities in select parts of the income market. And I think the beauty with where yields are right now, you can rely on bonds for income, but you can rely on bonds for adding alpha and performance in your portfolios right now. And history is on our side. Bonds tend to do well when the Fed is on pause.
Yes, and they are on pause, and now the market has decided to wake itself up and say, look, September could be potentially live. And I just want to get a sense from you. We debated that there was this hump or bump in CPI in the road and that it was going to be tough. Now the market has pulled forward and looked at 2 rate cuts. That is very much consensus for you, but you want to be positioned more at the short end of the curve rather than at the long. Why?
That is correct. So we think that, you know, the markets got yesterday some good news, but we're still looking at inflation being above the target of the Fed. We still expect to see volatility ahead of us, and we don't think the Fed is going to cut rates before the end of the summer. And we also have other reasons to believe that the long end of the curve is still susceptible to volatility, more structural reasons, the fiscal part of the story, structural reasons that are driving inflation upwards in the long term. And that is the reason why we're more cautious on the U.S. duration, so staying closer to the front end and the belly of the curve. But I also think the divergence of monetary policies and yield differentials that we see right now create opportunities to position differently in other parts of the world. And we're more comfortable, for example, owning duration in Europe and certainly in the UK. So again, going back to your beginning statement, yes, it does pay off to be more active in fixed income right now, and there's certainly tools out there to do that so.
And that's interesting, is that you're more bullish on gilts and bunds, perhaps, than you are on treasuries. So are you active in those kind of spreads? Is that how, do you play it outright picking up UK and European duration, or do you look for the differential and the spread?
Yeah, I think right now it's about kind of that difference in the monetary policy. We have more clarity where the ECB is going and where the BOE is going versus in the US. And what we're seeing from investors and ETF flows, for example, is that, you know, when you look at European fixed income markets, it's about real yields. And real yields in Europe, in the UK, have turned positive since the end of 2022. And that real yield differential between US assets and European assets has really narrowed down, even though the nominal yields are still quite different. And I think that is why we see investors, definitely when they use ETFs, staying closer to home. We see a lot of demand for euro-denominated fixed income ETFs. And as I said, just having that more nimble approach to building portfolios.
And this compounds, I mean, I want to extrapolate this into credit, because I know that you've downgraded credit, your credit strategy, and that's more of a US downgrade. I am dying to know why you've done that. I want to know whether it's cracks in the consumer, the spreads have compressed too much, or is it that you are concerned about some kind of a slowdown and a refunding wall here relative to high yield and IG in Europe?
Yeah, that's a very good point. I mean, listen, investors are definitely recalibrating portfolios right now. Investors are still underweight fixed income. So we have to consider the two lenses of how you build a portfolio, and that is on a strategic basis and on a tactical basis. On a strategic basis is where we downgraded investment grade to an underweight, and that is purely based on the spreads having tightened so much, but also looking at a little bit long-term, potentially the higher cost of capital and the refinancing that we see in the future, potentially causing spreads to widen further. But this is not a story for 2024, and that's where, again, putting on our tactical hat and where can you make money this year, tactical opportunities do exist. We have a preference for European credit, both IG and high yield. When I look at Euro IG right now with yields above 3%, you're getting more yield from bonds than you get from European stocks. And when you look at Euro high yield, for example, again, that's where the dynamic in duration, it's relatively a short duration market. You get the yield pickup, the issuance that we've seen, which has been incredible this year, has been so well absorbed, and investors seem to continue to love credit. We had more than 30 billion going into credit ETFs in 2024 already.
No, listen, I hear you, and I understand the underweight perspective for the sovereign relative to the credit. One thing I do want to get a perspective on is how much you and the House are talking about debt. Because we caught up with the Goldman president and CEO, John Waldron. He spoke to Bloomberg, and he said that the US government should not be lulled into thinking there's an insatiable appetite for debt ever ending.
Those of us that have been watching this for a long time are worried that this is an unsustainable pace and that we need to show more discipline in the system. And, I think the U.S. continues to be a great place to invest.
So that's John Waldron. I mean, we've had warnings as well, Vasiliki, from Ray Dalio in the FT overnight, from a number of other heads at the Qatar Economic Forum this week, talking about the risk, the real risk of a choke point in the U.S. Treasury market. Is that a real material risk that you talk about? And I presume it's a 2025 risk rather than right now, right here.
Exactly. So it's not a risk for this year. It's a risk in 2025. But I think that comes back to our earlier points around volatility in data, volatility in macro. And I think that's where we see investors trying to manage risk in their fixed income portfolios, whether that's coming from rates, whether that's coming from the inflation data, from the fiscal point. And to me, that's why I see, for example, trading volumes in fixed income ETFs surging in times like this, because people want to be more active in their fixed income portfolios.
Well, hopefully we haven't missed the boat with that sterling trade on the gilts. Vasiliki, great to have you with us. Great clarity around the calls from credit to sovereigns. Vasiliki Pachatoridi, my guest this morning from BlackRock. Context matters.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people. It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper. I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
It is Bloomberg Brief. I'm Manus Cranny in New York. So the Wall Street fund managers have shown us what's in their 13F filings, and many of them shifting into the tech sector, no shock there, propelling the market. But one of the big discoveries was for Berkshire Hathaway, $6.7 billion stake in Chubb, the insurer. Now, it's no shock that it's an insurer, but they were given a bit of a reprieve on this. Shonali Basak joins me now. So it was a final curtain reveal. We know Warren Buffett loves insurance. Where does Chubb fit into the family? What's the size of the holding? Just put a bit of context around it for me. Good morning.
It's a very large holding here, and good morning, Manus. It's a talk of the town, really, when you think about the insurance industry, because Berkshire, of course, has its own massive insurance operation, Geico being a part of it. So you would think on the face of it, why would they be taking a nearly $7 billion, a $6.7 billion stake in Chubb? And when you think about it under the surface, really, Berkshire is also a reinsurance company. When you think about the insurance industry, there's a lot of frenemy behavior going on here. It does spark a massive question under the surface on what the motive is here. Does Berkshire want to play a role in a broader industry consolidation? Chubb, remember, is run by Evan Greenberg, the son of Hank Greenberg, who built AIG. They built Chubb into a massive insurer through the purchase of ACE. And so can they do more? Remember, this is an industry that is facing a ton of cost pressure, and scale could really help the industry out.
I just wonder at what stage regulators look at the holdings, Geico, National Indemnity, Aon, Chubb, and they say, you've got quite a grip on pricing in this market, or is that even being floated as a kite at the moment?
Yeah, that is certainly a question. This is an industry that's consolidated significantly, and Berkshire plays one of the largest roles. We have seen regulators take a look at before, but this is also an industry that is regulated state by state, very significantly in the United States. We have not seen a whole lot by means of putting the clamp down
regulation
on that type of consolidation, but this is another era. If we did see a type of merger play start to happen here in this administration, of course, we know it's been tough on antitrust.
Now, of course, what Michael Burry does, the whole world sort of looks at through the lens, I suppose, of the movie. But he's a very credible fund manager, a very credible manager, and he's doubling down on China.
He sure is, and remember, he had exited a lot of these positions just last year, so this reversal is also interesting. And we think about motive. Remember, these are positions held at the end of March, and so when we look at 13Fs, there is a lag time, but he did get back into the likes of JD.com and Alibaba, and we've seen diverging performance this year in a lot of those large Chinese tech names. Now, when we talk to a lot of fund managers, they do say they see a tactical opportunity in Chinese stocks, but we do see differing opinions here when it comes to these Chinese holdings. We see Coatue, for example, increasing, JD.com and Baidu as well, but Tiger Global selling some of their JD.com. So is there a lot of trading versus long-term holding in these kinds of positions?
Now, Peng Zhao was here in the building last week at the Sell-Side Forum. I caught up with, I just literally said hello to him and Eric Schatzko before they went on stage. He was pretty bullish about the business that they're doing, and it has quite literally rained money over there.
There are the hedge funds, and then there are the market makers. To your point here, Citadel Securities has been minting money in the empire of Ken Griffin here. Citadel Securities being the market maker, $2.3 billion of net trading revenue in the first 3 months of 2024. That is setting them up to potentially have a record year. They have been adding products. They have been hiring talent from all across Wall Street. This is very noticeable because
up 68%.
Stunning.
Year over year.
Stunning.
I'd love to be in the bonus negotiations for the different desks around there, because I think that would be tempting. But I mean, this just shows you we've got monster rally in markets, and so that naturally drives up the commission rates on these deals as well.
It sure does. There's a lot of volatility in markets to profit off of. Remember, there's also bank regulation hearings this week as well. And as they tighten the screws on the large banks, you wonder how much these market makers can grow even more.
Shonali, thank you very much. Setting the agenda on 13Fs and Citadel. Well, two bellwether companies will report their earnings today before the bell. You're going to find out what Walmart made, an insight into the consumer, and then you've got Deere's results, just exactly how the global economy is performing. Dasha Afanasia joins me now, covering Walmart this morning, and Christopher Chileno from Bloomberg Intelligence, Chileno, joins me now. So where should we start? A little bit of Walmart, because you've got that battle between Amazon and Walmart kicking off. Dasha, good morning.
Good morning. Yeah, I think with Walmart, you can look at the economy and the state of the economy, which is pretty strong in the US. So on the one hand, you've got GDP not growing that quickly and disappointing last time, and unemployment increasing, but it's only at 3.9%. And I think for consumer companies, the real issue is what the Nestle chief executive, Mark Schneider, referred to as the bifurcation of consumers, which is where the people who are really kind of hard up, the lower income consumers, are having a really tough time. There's been a reduction in food stamp payments, they're budgeting week to week, and it's those kinds of consumers that Walmart might see spending less, even as the economy overall looks quite strong.
And then I suppose we've got to keep an eye out on the management's response to some of the uneven economic times and that competition from Amazon. I know Amazon is a wholly different company, but they are still there on the retail side as well, aren't they?
Absolutely. I mean, right now, Walmart is the world's biggest retailer, but the pace that Amazon is growing, it is catching up. So the company has taken steps to get costs under control, keep growing its e-commerce business. So it's actually reducing the number of corporate jobs that it has and ushering its remote workers into fewer hubs to save on costs. That's on the operational kind of cost side. But then on the promotional and marketing side, promotions are a big thing in the US right now, and consumer companies are faced with this dilemma. Do you use promotions to protect your market share, or do you protect your brand value by staying off the promotions and hope that eventually your brand will win? And finally, kind of in a hint of an appreciation of the splitting off of the consumer in the US, Walmart is actually targeting the more premium, the more middle-class consumers. It's been renovating its stores to try and compete with companies like Taggart for these sort of more treat products. So you have duck breasts, blazers, cargos in these renovated centers with kind of better lighting, mannequins, and that obviously takes investment. So the bet is that whilst appealing to the lower income consumers with lower prices for very necessary items, they'll also appeal to the more resilient part of the segment.
Yep, it's really just trying to get the blend right in store. Dasha, thank you very much. Dasha Afanasieva on the outlook ahead. We're going to get those Walmart numbers shortly. Turning to Deere, it's the bellwether, if you want to think of it in that way, for the global economy. Christopher Chilino, industrials analyst over at Bloomberg Intelligence, joins us now. So what can we expect for Deere's second quarter results? How exposed are they on a global basis, let's say to China and to other parts of the world that we have been consistently worried about?
Yeah, well, Deere certainly faces cyclical headwinds and a pretty challenging setup in 2Q as global ag markets continue to soften, just given the weaker farm economy. I'd say less exposure to China directly. It tends to be more indirect, as they're obviously the largest buyer of our crops. But not to mention, we still have this high interest rate environment. There's been, the age of the fleet has come down pretty precipitously over the last 3 years because we've had some real strong buying. So from a demand perspective, we really continue to see incremental weakness in the quarter, which we think is likely going to necessitate some additional production cuts, as we already have too much inventory in the channel. So we'd expect Deere to really underproduce retail demand globally over the balance of the year. You combine that with some mixed headwinds. They also have a tough comparison. 2Q is really going to be a difficult quarter with both double-digit top line and earnings compression. And we actually saw both their peers, CNH and AGCO, cut their 2024 guidance this quarter. So I suspect that we'll see Deere trim their outlook as well.
And tell me this, where are we in the agricultural cycle? We had Jeff Curry with us talking about the commodity cycle. Copper is the new oil, but obviously those are on the hards, and there's a different story there. On the agricultural side, the question, I suppose, for you and the team is, are we somewhere near a bottom?
I think it's probably too premature to call a bottom in the ag cycle. I mean, we're just coming off a peak last year. A lot of the ag indicators that we watched, I'd call maybe mixed at best. Farm fundamentals continued to deteriorate. And we're looking at probably another bumper crop this year, which is really going to keep downward pressure on crop prices. So, and we also have this uncertainty about the duration of this inventory destock. So historically, you know, downturns in the ag cycle don't last 1 year. I don't think this year will be any different. So we actually see more downside risk to the ag cycle and estimates in 2025.
Okay, Christopher, thank you very much. That is Christopher Chilino on Bloomberg Intelligence. We'll see what those numbers are in a little while. Coming up on the show, we're going to get you set up for your trading day. From the results to the macro, right here on Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit Search Go to find answers now.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From the world of politics to the world of business, every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
This is Bloomberg.
Hey, it's Bloomberg Brief. I'm Manus Cranny in New York. A look ahead for today. This is what we've got. We've got Fed speak. Patrick Harker, Loretta Mester, and Raphael Bostic throughout the day. So all eyes down on that. Walmart and Deere, as we say, will report before the bell. And Bloomberg talks exclusively to the JP Morgan CEO, Jamie Dimon, at the JP Morgan Global Markets Conference. That is in Paris at 8:15 a.m. Don't miss that conversation. How does he see the U.S. economy? What will he have to say about debt? Francine Lacroix sits down with him. Micro movers, Cisco, we've been telling you solid set of results, profit forecast for the current quarter. Stock is bid up. You've also got Tesla and NVIDIA in here this morning. Tesla announcing more than 600 job losses, and NVIDIA with the 13F filings strong and hard there, moving towards NVIDIA. Some other stocks to keep an eye on. You've got Cisco bid up on their guidance. Chubb on the Berkshire Hathaway position, taking a $6.7 billion stake in the insurer months after suspense in that. And Grab Holdings reporting third consecutive quarterly profit, helped by efforts to cut costs in competition in Southeast Asia in the the ride-hailing and delivery markets. I leave with a view of the government bond market. We just had a conversation with BlackRock, and they very clearly say they want to be more exposed to German and UK. That's their preference relative to US government bonds. That's a question of divergence.
Names in global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable. Not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
Good morning. This is Bloomberg Surveillance.
This is Bloomberg Daybreak Europe.
You're watching The China Show.
This is Bloomberg Technology.
This is the countdown to the close.
Welcome to Balance of Power. This is Bloomberg.
I don't think that we're heading into a higher for longer environment. I think we're heading into a normal for longer environment.
I think where we are now is essentially the new equilibrium. I don't think we're getting back to 2%.
The higher for longer is going to stay there.
Above all, the Fed understands that reestablishing price stability is key. They're not giving up the 2% inflation target.
The economy is doing fine, and I think inflation is on its way to 2% by the end of the year.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance coming into Thursday at all-time highs on the S&P 500 and the NASDAQ 100. You've had the data. Here comes the Fed speak. This is the lineup. Barr, Barkin, Harker, Mester, Bostic, all on deck today, Lisa, following that softer than expected headline inflation read.
Is there anything they could say that matters? And I say this because so far we've heard basically hawkish light speak, even from Jay Powell, basically saying that it hasn't come down as quickly as we'd like. And the market said, we don't believe you. We don't care. Right now, even a 0.1% sort of miss in terms of CPI is enough to bring back the prospect of a September rate cut and then another one in December.
The future's positive this morning by 0.2% on the NASDAQ. We're up 1/10 on the S&P 500. The rate cut talk simmers into the summer. I'll go through the calendar briefly for you. We get another read on CPI the same day as the next Fed decision, June 12th. You'll get another read on July ahead of the Fed decision at the end of July. Is that enough time to have this conversation about a rate cut later this summer?
Well, it's not for Neil Kashkari, who already heard from yesterday, and his quote was, "It's unknown in terms of how much downward pressure there is on the economy, and that tells me probably we need to sit here for a while longer." And he was talking about maybe we only have 1 foot on the brakes and not 2.
All I could say is this is a market that wants to rally. Period, full stop. I mean, basically, it was the downside was, it would kind of stay flat. The upside was to the moon. We heard from Ed Yardeni yesterday saying 6,000. At what point is the Fed just sort of getting away from the narrative? And basically, at this point, the weakness is being dismissed. Disinflation is sort of baked in. And it doesn't matter what Fed officials say. I think the key question is going to be, how much is this market rally dependent on Fed rate cuts at all versus just simply not a reacceleration of inflation?
It's a question we've asked repeatedly on this program. The Fed chair has retained this bias to cut interest rates regardless of what happens with the economic data. He still retains that bias. The question we've all got now, was the head fake yesterday or was the head fake Q1 inflation data? We can have that conversation through this morning. It's not just about inflation, it's about retail sales as well. They're coming in just a little bit softer than expected. In about 50 minutes time, an hour's time, we'll get numbers from Walmart.
I'm looking forward to those because we are seeing this weakness in the retail sales number, but also in consumer sentiment. Home Depot was also a little bit softer. You see people are starting to defer some of the big projects they want to take on. What are everyday Americans buying and what are they not? And are they stopping for some of these mass big ticket items?
Walmart right now positive by 0.8%. I've mentioned some dates for the diary. 2 more. June 27th, CNN. September 10th, ABC. Did we just agree to some debates?
They did agree to debates. This is outside the Presidential Commission. They're going to go right to the networks. I have to say, though, when I put it out on Twitter, some people said, I take the under on this. There are people who are still skeptical that Joe Biden and Donald Trump will show up. But right now, it is slated for the end of June for CNN in Georgia.
Team Biden, anytime, any place, but not under just any conditions. Apparently no audience, and they want the option to cut off microphones as well.
Okay. I think that that's the point of the skeptical, the people who don't think it's actually going to happen. And then there's a question of what happens to the traditional way that debates are established. And then, of course, there's Trump, who says there's one from Fox News, and Biden saying, we don't know about that one. So TBD, that's all I can say.
Anytime, any place, but with conditions. With conditions. Equity futures right now on the S&P. Here are the scores. Positive by 0.1% on the S&P 500. Yields are just about lower by a single basis point. 4.3322. What a turnaround in the bond market over the last month or so. And the euro, just a little bit of weakness after a day of strength against a weaker dollar. Euro dollar 108.70 was softer by 0.1%. Coming up this hour, we'll catch up with Julian Emmanuel of Evercore as equities rally to all-time highs. Kit Jukes of SocGen as rate cut bets rise on cooling data. And Bloomberg's George Ferguson as the DOJ moves a criminal prosecution of Boeing. We begin with our top story, slowing inflation fueling a record-breaking rally. Julian Emmanuel of Evercore saying this, our base case remains an ongoing correction which ultimately tests the S&P 500. The potential for further near-term upside cannot be eliminated given that economic surprises lie at almost the exact intersection of Goldilocks and too cold. Julian joins us now for more. Julian, good morning to you.
Good morning.
Let's start with the data yesterday. What did you make of that?
Look, clearly the market liked it, okay? That tenth of a tick lower in the monthly number was certainly celebrated. But then you look at the retail sales, again, that's the intersection of Goldilocks and too cold. And if you stripped out gasoline, the number would be even weaker than the headline 0. So for us, look, the ebullience around the Fed's activity or lack of activity or wherever their path is leading has certainly driven the animal spirits higher. But for us, the bottom line is 3.4% CPI, 0% retail sales, other signs of economic weakening. That doesn't say that the upside is unlimited as the market is trying to behave.
Is this a record high you want to sell?
We want to be tempered about it. Look, what I'd say is this. Again, when you're facing a momentum market, the likes of which we have, to say that momentum is going to stop on a dime is a very difficult call. We do think, though, that this is one of these times. Think about the beginning of March. Think about last summer when all of the news feels as if nothing can go wrong. That's probably the time to do a little bit of hedging.
Which would have been 6 months ago, which probably would have been a while back, as people basically were saying, well, things seem like they're priced to perfection. What gets us to 47.50, which was your projection about a month ago?
frankly, it is again this intersection of inflation staying stubbornly sticky. And if you think about the months coming up, it's not likely the readings are going to get a lot better, which is, I think, why you've seen, and you will probably see today, the Fed governors come out and talk about counseling patience here. And frankly, when you think about it, the equity market is now sort of working in their favor to promote the narrative of patience. At the same time, again, the monetary policy of the last 2 years is finally starting to kick in and slow the economy.
You said that the equity market is promoting the narrative. Some people might disagree and say it's actually moving in the opposite direction, and it's promoting the idea that actually things are going great. And, if financial conditions matter, could reaccelerate inflation on the other end. Why do you disagree?
Well, so, again, this is the fine line, right? We're going to have annual comps in the next few months that will make it seem as if inflation is sticky. Ultimately, the longer-term course is the same course that we've been on for the last year, and that is lower inflation. And frankly, that is part of the benefit of the slowing economy. But it's sort of it's a gradual process, and I think the market is a bit too overenthusiastic about the fact that this is the path to success without bumps.
But you do think inflation is coming down, but you say September, December, those rate cuts are not guaranteed. Where's your thinking now in terms of rate cuts?
So our base case is that they do go twice, but it's a very fine line at this point. If the data does, as we think it could, prove sticky, they're going to have to reconsider, and I think that's why you're seeing the narrative come out the way it is. And so, given the political schedule, it may end up being no cuts this year.
So record highs on the NASDAQ, record highs on the S&P 500, small caps participating, and we're all trying to work out what to buy. What do we do now?
We think the case for small caps is very interesting.
Why?
Okay. Number one, it's one of those things, and we've seen this time and again throughout the last decade or two, when the enthusiasm around large cap tech gets the way it is, and next week will be an interesting data point to test that enthusiasm when we get the stars earnings reported. The discount is extreme. The seasonality around the Russell indices rebalance is very reliable. And the sentiment, small caps have been the funding short for active managers for almost 2 years now.
New York Fed President Williams speaking right now to Reuters. April CPI, a positive development, says that policy is restrictive and in a good place. We've heard that a few times. You just said maybe no cuts this year, and then straight afterwards said buy small caps. What's the relationship between the two? Because a lot of people might say you need one to get the other.
Well, interestingly enough, if you actually don't cut this year, you may, in fact, hold longer-term yields in check by remaining with that degree of discipline. And frankly, when you think about stocks in general, they're much more sensitive to longer-term yields in terms of discounts.
How much is some of the confusion just a valuation story? That essentially, it's hard to make an argument based on what you just said for small caps. If you see inflation, sort of a question of where we are between this Goldilocks and something that's more pernicious in terms of a hard landing. You're not sure what's going to happen with Fed rate cuts. Is your case for small caps a valuation one, and your case against large caps also a valuation one?
Well, valuation is probably more important than it has been, and quite frankly, it's uncomfortable for us to talk about valuation. But when you get to these kinds of extremes, and they're not extreme, for instance, in Y2K, you got to 28 times, which is 6,300. We don't think that's the case this time. But it is, one needs to stick to one's discipline and realize that, nothing tends to last forever when you get to these type of extremes.
We were talking with Ed Yardeni yesterday, and he said there's clearly a broadening out. And you can see it not just with small caps, but you can see it also with this idea that now everything is an AI play. Utilities are an AI play. How much do you sort of buy into that and ride the sort of morphing wave that's shifting from industry to industry as everyone understands some of the efficiencies that can take place?
Well, so again, the comparisons with the internet in the 90s are apt. But, we recall that to get to full internet adoption over the course of the last 20 years, you know, you had several recessions, you had several bear markets. It's not a smooth line function. And we do think that the potential for AI to secularly improve productivity across the entirety of corporate America is there.
Julian, we'll get a bonus round with you. You're going to be sticking with us. Kit Jukes joining us as well in just a moment. Kit Jukes of SocGen with this morning. Yesterday's CPI data highlight the market's lack of conviction and tendency to be led, if not by the nose, then by each of the major data points. That makes for choppy markets, but not trending ones. He goes on to say, leaves anyone trying to overinterpret data in danger of being fooled by random short-term surprises. You wonder how quickly this conversation can change from data point to data point. Kit Jukes just around the corner. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Slovakia's Prime Minister Robert Fico suffered life-threatening injuries after being shot in public. It's the first assassination attempt on a European leader in more than 2 decades. The 59-year-old was admitted to the hospital in very serious conditions. The police say that the gunman had a clear political motivation. Fico returned to power last year as a force of opposition to EU institutions in Brussels. Chinese President Xi Jinping affirmed that the relationship with Russia remains strong. He told Vladimir Putin that the ties between the two nations should last for generations. Putin's trip to Beijing is his first foreign visit since he started his 5th presidential term. As Russia intensifies its war against Ukraine, Putin described the ties with China as, quote, one of the main stabilizing factors in the international arena. U.S. CPI data was accidentally published 30 minutes early yesterday. There was no obvious sign that the early publication moved markets, but the Bureau of Labor Statistics said it is launching a full investigation. This isn't the first time that BLS data practices have come under scrutiny. A month ago, Bloomberg reported that a BLS economist corresponded about CPI's components, answering numerous questions in detail with major Wall Street firms, including JP Morgan and BlackRock. That's your Bloomberg Brief. John.
Danny, thank you. I mean, it goes without saying that that's a problem, Bramo. We were joking about it maybe leaking a day earlier, but apparently it was 30 minutes earlier.
I'm just thinking to myself, darn, why didn't I look at the website earlier? Why did no one catch this? I mean, come on.
Nuts.
Right?
Because we're all staring at the Bloomberg terminal, waiting for the proper time at 8:30 Eastern when it should come out. Doing the right thing. Up next on the program, the Fed sitting tight.
We probably need to sit here for a while longer until we figure out where underlying inflation is headed before we jump to any conclusions.
That conversation just around the corner. You'll hear more from Julian in just a moment, and Kit Jukes of SocGen on the other side. Live from New York City this morning. Good morning.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Equities on the S&P 500 just about unchanged. Live from New York, good morning and welcome to the programme. Yields are going nowhere on a 10-year, 433.42. Under surveillance this morning, the Fed sitting tight.
How much downward pressure is monetary policy putting on the economy? That's an unknown. We don't know for sure. And that tells me we probably need to sit here for a while longer until we figure out where underlying inflation is headed before we jump to any conclusions.
So here's the latest. Minneapolis Fed President Neil Kashkari repeating that the Fed is likely to hold rates steady for a while longer as investors bring forward rate cut bets. The Bloomberg Dollar Index falling to a one-month low, with Treasuries mostly adding to their advance following CPI data. Kit Jukes of SocGen joined us now for more. Kit, you wrote about it this morning. We're at the mercy, seemingly, of the next data point. There seems to be no trend. Is that what you're advocating to clients this morning? Don't get too excited about yesterday. It could change next month and the month after again.
Yes, definitely in the short run. You know, I mean, look, the Fed is clearly data watching too, so the markets have no reason to do much that's different in the short run. I think we probably learned, I mean, if we're close to learning that the next move the Fed will make will be a cut, not a hike, unless it's in years down the road. So the upside for the dollar is somewhat capped by that. But, you know, we've had 3 low 0.4 CPI monthly prints followed by a 0.3. You wouldn't want to over-interpret any of this. They'll need more information. We've got an election coming. You know, I think the market is going to be just waiting for the next data point before it does anything else. And yeah, we look as if we might have defined a fairly narrow range for the dollar to trade in.
It's been truly exciting, though, Kit. I mean, for the past year, it's been just absolute fireworks in the euro-dollar cross, and we talk about it every single day. Are you basically just explaining why we're not moving out of this anytime soon, or are you saying that it needs to be an even tighter range, that people are going to get really their faces blown off if they try to do something that is more bold?
In my mind, euro-dollar is in a 106, 110 range for as far as I can see, with any great confidence, and I think it goes a bit higher in next year. I mean, it's almost that bad. Look, the politics will move that range around quite a lot as we get through the fall, obviously. But yeah, the really surprising thing, in a sense, is that after all the shocks we've had from the macro events, the geopolitical events since the beginning of 2020, that the U.S. economy is having a gossamer soft landing, which I wouldn't have believed possible. No one did that on the Hudson, and we're settling down and just really saying, okay, so what happens next? We're not sure.
There's a question about the European side of things as well, given the fact that we saw a number of GDP prints come in stronger than expected. You do see industrial strength returning to certain regions. I see you kind of going like this. Maybe it's from a very low base, but how much is that something that could drive a bit of strength as well? It's not just the U.S. side, it's also what's going on over in Europe.
It's not irrelevant. We got to the point where the markets were so pessimistic about Europe that it was almost impossible to think which piece of European news would be bad enough to make things worse. Now I think we're moving to a point where instead of stagnation, we've got slow growth. And I think the most growth-sensitive currencies, for example, the Norwegian krona particularly, maybe stands out in Europe. Maybe they have room to have a bit of a rally just because they have a bit of leverage on that recovery and sentiment. The key for Europe will be the German economy, because clearly the situation in Ukraine, clearly Germany's reluctance on gas, natural gas, and clearly its heavy industries and its trade position with China are all sort of fairly serious issues in the long term, not just now. But I've said it often enough in my mind about sterling. When all the news is nothing but bad, it doesn't take much for a currency to go up on the back of slightly better news.
Kit, question. The narrative has been that the ECB has been able to sort of give out this declaration of independence from the Fed in terms of its own rate-cutting cycle. Is there a price on euro-dollar where that declaration of independence has to be amended?
I'm not sure. Not necessarily. I mean, it's certainly the Declaration of Independence. Maybe if we got back under the 2022 low at 0.95. But remember, we only got there on the back of the biggest terms of trade shock in favor of the dollar and negative for the euro since any of us were born. So that's quite a long way away from here now, but also quite a long way away in terms of what the situation is. I think it's quite solid. I mean, where it gets tested, I think, is by the Fed hiking while the ECB's easing. So if the Fed were to raise rates twice and the ECB were to cut rates twice at roughly the same time, I think, I think I'd go and hide under the sofa over some of the behind the sofa for some of the data points. But I don't think that it's written in stone. They have to move, step for step. And you can see by the yen, you can have quite big currency moves that don't have a major impact on the economy. I mean, the Japanese are not getting the kind of economic recovery you'd like to see from an economy whose currency has just lost that much of its value.
Yeah, we all noticed the Ministry of Finance in Japan popping its head back over the sofa kit yesterday. It could look. Better news for the Japanese. Is the worst over for them in the FX market?
I know, tell me if we've seen the high in 10-year note yields is almost the answer to that, because that's what the yen's following. It doesn't feel to me, I mean, we're probably one solid US data print, too, from a rise in US yields that gets us to 160 again. The people who've been selling the yen have been earning carry the whole time. They might have given back some of their profits, but every day they pick up more money from the carry of that trade. Volatility's coming back down, so owning trades is getting less expensive. So they're getting a period of calm, but you wouldn't declare the whole fight over yet. The basic driver, that huge interest rate differential, has not gone away.
Okay, I'm thinking of you going into the weekend as an Arsenal fan. Good luck, sir. Kit Jukes at Solchen out of London. Thank you very much. Tough couple of days for Arsenal fans, given what Tottenham couldn't do, but we knew that would happen, didn't we? Let's get some numbers from Deere. They've cut their outlook for profit. New numbers for you. They now see full year net at about $7 billion US, the previous range, 7.5 to 7.75. Lisa, the stock is down by close to 6% in early trading.
They explain the why, and that's basically that farm income has been easing, in part because prices have been coming down. This is the flip side to disinflation, or in some cases, outright deflation. It actually has been a driver of earnings. The idea that we've got inflation and disinflation or deflation isn't exactly the panacea for some of these industries that people were thinking.
Julian, what's your reaction to this one?
Well, the agricultural income definitely has been under pressure, and it's not a story that's well understood when you think of, the price of cocoa, for example, in recent months. But wheat prices have really been in a downtrend for months on months, and our industrials analyst thinks that that ag cycle has to work its way through. We have a bit more cautious view on that sector.
The idea here that the shares are lower by 6% also tells you something in terms of the reaction function that we've seen so far this year. Any misses have been punished, and that we've talked about that extensively on this show. Are we reaching the end of that? We're pricing in a more potential weakness, and we're not going to see this kind of massive reaction, or is this the new normal?
Well, actually, and if you look at it, this is now the second quarter running, and we would expect that to happen next quarter as well, because the stock market has been a market of stocks and not a stock market, very uncorrelated. You're going to have these individual reactions in extreme, and it's less about, well, if you get misses like this, you're definitely going to get that kind of reaction, but a lot of it is positioning.
Julian, just before you go, in about 35 minutes, we'll get Walmart. You don't do single names on TV, I understand that. What would you look for from a name like that when they report?
It's really a generalized state of the consumer, and is there any pressure that they're seeing on the low-end consumer, because that's where all the stress has been noted in recent weeks.
Those numbers about 35 minutes away. Julian, always a pleasure. Privilege, sir. Thank you. Julian Emmanuel there of Evercore. Let's turn back to Deere. New outlook for full-year profit. The net at about $7 billion US. The previous range, 7.5 to 7.75. That stock is down by close to 6%. The commentary from the CEO, here's the quote this morning: "We are proactively managing our production and inventory levels to adapt to demand changes and position the business for the future." That stock is negative in early trading. Coming up on this program, we'll talk about a stock that's been negative for most of this year. Bloomberg's George Ferguson on the possible criminal prosecution of Boeing. That conversation is just around the corner. Walmart numbers not too far behind, 34 minutes away, with equity futures just about positive on the S&P 500, coming into Thursday at record highs.
Top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Live from New York, welcome to the program. Equity futures on the S&P 500 just about positive. All-time highs yesterday at the close on both the S&P and the Nasdaq 100 for the first time since March. On the Nasdaq, 5-day winning streak coming into this morning through yesterday. We're positive again. We had some more weight to that rally, up a little more than 1/10%. If you switch at the board and get to the bond market, what a turnaround we've seen in treasuries. Think about where we were at the front end of the yield curve to close out April, north of 5% and all the way back down to 473.82, up a single basis point this morning on twos, on a 10-year going nowhere. Lisa, 433.80.
Yeah, but 10 basis points on a 0.1% downside miss yesterday. I have to say, I read note after note, and they all had completely different interpretations, talking about the Rorschach test of 2024. Basically, RBC coming out and saying they still think that it's going to begin in December. Mizuho says, just wait a second, because we think that actually we've seen a stalling out here at 3%. Everyone has a different take and an interpretation, so welcome to the market in 2024.
Those takes didn't change yesterday.
Exactly.
There was nothing about yesterday that changes the base case, which for equity markets, I guess, is good news. It doesn't get any worse.
Everything is good news for the equity markets right now, because you're talking about hitting that sweet spot. Kit Jukes was talking about that perfect nirvana that he had discounted as well. That seems to be the reality.
Let's turn the board and get to the US dollar against the euro. The dollar index, DXY, having its worst day of the year so far in yesterday's session. Against the euro, we are negative by about 0.1%. That's in the dollar's favor. Yesterday, the dollar weaker against absolutely everything in G10. The euro, Lisa, getting close to 109.
Yeah, although Kit Jukes pouring any cold water on the idea of some sort of narrative shift where suddenly we're in this sort of weakening dollar trend, just saying we're still caught in this range. Unclear how much you can really derive from this, but there has been a broader story about exceptionalism broadening out. And a lot of that is pegged to the fact that the U.S. is not alone with industrial policy anymore and investments. That's creeping to the outside of the country. That's what I'm watching.
Kit Jukes, the SocGen, I think put it perfectly, as he often does in his morning note. We're at the mercy of the next economic data point as the narrative just gets whipsawed from one end to the next. Anyone can try to overinterpret the data. They're in danger of being fooled by random short-term surprises. There is no strategic anchor coming from the Federal Reserve. This is what Mohamed El-Erian has warned about repeatedly, and for that reason, we just swing from one data point to the next, from 7 cuts to 1, back up to 2, and who knows when that's going to start.
So tune in as we overanalyze every single data point that comes out, because ultimately people have nothing else to go on. Each company is a different story, and that's part of the problem. Is that, okay, do we go to Deere and this idea of agriculture demand, or do we go to Walmart and see what they say about the broader economic outlook? What's going to be the next one that really gives that overview that we used to get?
Jobless claims in 2 hours' time. We'll do it all over again at 8:30 Eastern time after that rare upside surprise in the previous week. We'll see if that comes back down. And if it doesn't, if it inflects even higher, then we'll get even more worried about the prospect of the economy turning over, and maybe we go from Goldilocks to being too cold, which is what Julian Emmanuel of Evercore is talking about. It's exhausting, isn't it? You're not alone. Under surveillance this morning, slowing inflation, boosting bets for 2 rate cuts this year. Investors looking ahead to labour market data with jobless claims in about 2 hours' time. Plus a host of Fed speak with Barr, Barkin, Harker, Mester and Bostic all on deck a little bit later today. Elsewhere, President Biden and former President Trump agreeing to at least 2 debates this election season. The first matchup coming June 27th on CNN, then September 10th on ABC. The debates will not be sponsored by the nonpartisan commission that has organised these events, Anne-Marie, for decades.
Yeah, 37 years, but this was a long time coming. Remember in 2022, the RNC said they're leaving the commission. They didn't like the way it was performing. Now the Biden camp is saying also, we're not exactly happy with some of the rules and way the commission works. So the commission has become pretty much obsolete. Although the commission, though, put out a statement and said, we will prepare for the debates if you guys decide you want to show up. And they're usually held at universities. Usually there's a live audience. That's something that is not going to happen at that first CNN debate in June.
Can we talk about the importance of June, why it is in June, why we are going earlier, and why Team Biden wants to make this happen in a big way?
I think one thing is that they see how dismal the poll numbers have been for the Biden camp. So the idea is to get a boost potentially. Remember, Biden in our polls got a boost after the State of the Union. He had a pretty strong performance. Some would say the bar was very low, but he had a pretty strong performance, and then he got a boost in the polls. Potentially, he could do that in debate and bring back the former president and some of the rhetoric that doesn't bode well with some swing state voters and some independents, bring that back into the living rooms of the American people.
Can I just say the fact that while the former president sits in a courtroom, his poll numbers are going up, that basically we're at a place where one person is trying to message and give a sense of what's going on and, you know, play all these different angles. Then you have one president sitting in a courtroom listening about a hush money trial. It's just sort of, you know, state of play in America 2024.
Inflation. And what you continuously see in poll after poll, even though the Biden camp says, you know, don't look into the polls too much, it is still early in the timeline to November, but inflation remains the #1 issue. And when you ask respondents, who do you trust more in the economy? Continuously, they trust the former president.
So I'd say a couple of things. Number one, I mean, yes, he's in court, but that's part of the campaign, and it's working in his favor.
Exactly.
Big time.
That's my point.
The second thing I'd say about the Biden move, Biden did very well, and he won an election not as the incumbent and making it a referendum on the other guy. He was able to do that because we were in a pandemic and he could hide away and just leave the spotlight on Donald Trump as everyone was suffering at home and then go to the polls later on that year in November. He can't do that this time around. He is the incumbent now, and the referendum is on him in many ways, and I'm not sure how they turn that round strategically, because at the moment they seem to be struggling with it.
And he has to be in front of the cameras. We saw him this week give an interview to Yahoo Finance, but it was about 3 minutes long. I think Brian Sazi, who did a good job asking about the tariffs and stuff, but he only got a short amount of time. Is Biden going to sit down for longer extended interviews that would be normal in election year?
We'll talk more about this a little bit later. Usually in debates like this is to get to know the candidate, right? I can't think of 2 candidates that are more well-known than these 2. Going back decades,
Almost
can you?
too much TMI.
But
Really?
What's the purpose? I mean, is it going to basically be a mudslinging match and who can sort of withstand it better, or sort of the carriage in terms of the attitude?
I think the purpose is quite clear. This is about early voting, which is why Team Biden wants to go early. They want this done in June because they know that people are going to make their mind up pretty soon. There is this belief in the Biden camp that there are a bunch of people that haven't really connected with the election just yet, and when they do, they'll lean towards him. This is why I think the June debate is going to be a big test of that theory. Do we actually get that bump in the days and weeks afterwards?
Also, potentially, it could be a huge bump for the former president. To Lisa's point, he's been in court every day. Yes, most network media has been wall-to-wall following his court trial, but this is a way for him to actually talk about something else other than his hush money trial.
We'll talk more about this a little bit later this morning. Let's turn to this story. Boeing facing a possible criminal prosecution. The Department of Justice says the plane maker violated a deferred prosecution agreement tied to 2 fatal crashes of the 737 MAX. Boeing has 4 weeks to respond before the DOJ decides how to move forward. George Ferguson of Bloomberg Intelligence joins us now for more. George, this is a company that's really, really struggling. Can you talk to us about what is at stake now and what kind of fines we could see come from the U.S. government?
Yeah, so my sense is that this is not going to be about the money, the fine money. My sense is that this is really about the DOJ holding Boeing accountable for what they promised to do, which is just put in better oversight, better compliance measures. I think they have to be very careful here, right? Because Boeing is a very important component of the U.S. economy and the U.S. defense establishment. I would say that, the company is already hurt financially. We saw them go into the financial markets, the bond markets a couple of weeks ago. for about $10 billion to shore up cash. As you know, they burned a lot of it in 1Q, and so they needed another 10 billion. They really need the turnaround to happen in the second half of this year to start to generate cash, or at least really minimize the burn, for the company to stay on stable financial footing. So again, I would go back to, I think they have to be careful about any fine levels that they would impose, and it's really about holding their feet to the fire on this compliance, internal controls, just keeping the spotlight on that for Boeing so they fix that and become a better manufacturer.
George, isn't that actually really difficult to do, to simultaneously acknowledge that Boeing is a special case and then at the same time hold the company's feet to the fire?
I think it is. Agreed, it's challenging, but I guess maybe it means you can't do it so much with money, but you'll have to use other levers like getting inside the company, increasing your oversight of the company to do it.
George, can you think of another company that is in this spot of too big to fail, too important to fail in the U.S. industrial complex?
I think there are a number of companies I think that the administration would think is too big to fail. And the reason I use the word administration is I would just go back to, like, if you remember the General Motors bankruptcy, right? I think the Obama administration realized that company was too big to fail. They couldn't let all those jobs go away. Another super important American manufacturer, and they changed rules to make sure they had shepherded GM through some of its problems. So yeah, there are, I think, a lot of companies like that we would look at in the economy that are too big to fail.
This raises a question, George, especially as we shift toward a much more industrial policy type of framework, a sort of central planning type of framework, with investments in other companies similarly to try to build up other infrastructure. Just focusing on Boeing, how much are we looking at that as being one reason why some of these issues with safety and speaking up and all of these other training programs have been able to be ineffective for as long as they have?
Boeing, yeah, I think I follow sort of where you're going with that question. I'm not totally sure I get it, but, actually, maybe you could rephrase it. So I don't totally get that. Sorry.
Okay, well, I guess that what I'm trying to figure out is this a case of Boeing not necessarily having the oversight? And the reason why some of the issues that keep on dogging them, this was an issue going back to 2009. Then in January, there was the panel issue. How much does this stem from a lack of oversight, a lack of discipline that has not been implemented on this company?
Sorry, I'm smiling because I apologize for not getting at the beginning. So look, I think what's really challenging about Boeing is they're the only commercial aircraft manufacturer in the country. So when their regulators approach them and try to oversee them, the people inside Boeing are typically the smartest in the room, and that makes it really difficult, I think, to put effective oversight into the company. And I think we've seen that's been part of this, breakdown we've seen over the last number of years, where the FAA hasn't been deep enough into their processes to tell whether or not they're doing a good job or not, right? And so part of this story is probably going to be the FAA reauthorization, them adding a bunch of money into budgets at the FAA, focusing more on oversight of these manufacturers. Because, again, I think the manufacturers, and especially Boeing, knew the most about the business, and there was no one outside there that could really put a good critique on the company.
George, I wonder if it can be the shareholders. What are you expecting from them in the next 24 hours?
I think it's very difficult for the shareholders to put proper oversight on the company. Again, it's such a, it's a very technical business. It's an important engineering business. I think the average shareholder, especially the ones with the big blocks of votes, don't know enough about it to put pressure on it. But I think they do understand when it's not working. It isn't working now, and the pressure will be on the management team. Challenge here is finding the new management team, finding people they think are good manufacturers, people that can set up good systems inside, and getting them on board. So right now, can't even apply much pressure to the management team because it's on its way out.
Yeah, the only name we've heard is sort of Larry Culp doing the rounds over the last few weeks. Yeah. Very, very little news on who might be taking that role. George, thank you, sir. George Ferguson there of Bloomberg on the latest on Boeing. Let's get you an update on stories elsewhere this morning. Let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. The Chinese government is planning a meeting with key officials over its troubled property market. Officials include ones in both the government and the financial sector. Bloomberg had reported on Wednesday that China is considering a proposal that would have local governments buy millions of unsold homes. Many of the properties would then be converted into affordable housing. China's cabinet is aiming to finalize that plan by the end of the month. Let's get you a quick check on Deere shares, down some 5.5% in the pre-market. The company cut its profit outlook for the year. Declining income from agriculture has put pressure on the world's biggest farm machinery maker. It's specifically falling grain prices. That's crimped the income for farmers, giving them less money to spend on machinery. The company's CEO said that they are, quote, proactively managing our production to adapt to demand changes and position the business for the future. And Netflix will be airing 2 NFL games on Christmas Day. It's the latest push for sports for Netflix. The company signed a 3-year deal with the league, but that also gives them at least 1 Christmas Day game on Netflix in 2025 and 2026. It also adds just 1 more platform you're going to need if you want to watch all the NFL games. So as it stands, games are set to stream across Netflix, ESPN+, Peacock, Amazon Prime, and YouTube's Sunday Ticket in this season. And that's your Bloomberg Brief, John.
Danny, thank you. Coming to a bundle near you, I'm sure. I've got problems with this. Got a few, but here's one. I don't get the football thing on Christmas Day. And I love watching sport, but Christmas Day is not for football games.
Do you think that families want to get around and talk the entire day? I'm just saying.
I do.
Okay, well, a lot of people are looking for something to kind of, grease the wheels a little bit.
away?
You can all cheer for somebody. You don't have to deal with the uncomfortable topics.
How would you feel as AC Milan game?
I still wouldn't watch.
Come
Plus, the Italians would never play on Christmas Day.
This is true.
Come on, blasphemy.
Oh,
Up next on the program, dueling mandates.
We're going to be very sensitive. If we start to see the labor market crack, they'll be sensitive even if we're not quite at that 2% level.
That conversation up next. Equity futures just about positive. Live from New York. This is Bloomberg.
I think this will probably go down in history as one of, if not the largest financial crime ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond. Few things to look forward to this morning. In about 15 minutes' time, we'll get numbers from Walmart. Look out for earnings from them. Then after that, 8:30 Eastern Time, we'll get a little bit more economic data for you. Jobless claims just around the corner. Equity futures on the S&P 500 going into all of that, just about positive and adding to gains from yesterday at all-time highs at a close on Wednesday on both the S&P 500 and the Nasdaq. In the bond market, yields just about unchanged on a 10-year, 433.61. Under surveillance this morning, dueling mandates.
I know that the Fed is talking about we have to get back to 2%. But I think there's a little wiggle room there. I think, when it comes down to it, if they say, that those last few tenths of a percent are worth destroying the labor market, they will hold off on that. And they're going to be very sensitive. If we start to see the labor market crack, they'll be sensitive even if we're not quite at that 2% level.
Here's the latest this morning. US jobless claims due out in less than 2 hours' time. Constant Hunter of Macro Policy Perspectives writing this. Our base case is continued growth fueled by continued productivity growth. But if the Fed has to cut because of weaker jobs data, the outcome is not as clear. We are probably looking at a soft patch to a mild recession. Constance joins us now for more. Good morning.
Good morning. How are you?
How encouraged were you by the data yesterday? You feeling good about that?
I am feeling good about that, and I think the Fed should be feeling good about that because we are on this trajectory towards a more normal inflation environment. The risk for the Fed, though, is that we're starting to see cracks in other parts of the economy, right? We saw the delinquency data come out, and we're seeing upticks in autos. We're seeing upticks in credit cards. You look at the ISM data. On the jobs diffusion index, that is pointing to some weakness. We saw a softer jobs print. And so the issue for the Fed is if they have to cut because it's jobs that weaken faster than inflation, they're behind the curve. And that being behind the curve puts us at a greater risk of a soft patch or a mild recession.
Can we just get into the evidence that might speak to them being behind the curve? How much weight would you put on something like, say, retail sales yesterday? How much weight would you put on that?
Well, I think you have to look at March and April together, right? Because you have Easter, you have Passover, you have weather, you have seasonals. So if you take them together, it wasn't super weak. However, we're seeing goods consumption finally moderate. I mean, we had 4 years of buying ridiculous amounts of goods, and now we're buying services, and that's a good thing, right? We're starting to see that come back. People are still behind on medical services, for example.
We were wondering how much to read into the initial jobless claims of last week, and a pretty big upside surprise, the wrong kind of upside surprise. We get initial jobless claims in 90 minutes time, a little bit more. How much are you seeing a shift? You talk about labor hoarding coming to an end. What does that do for the likely path of jobless claims?
Yeah, I mean, it would suggest that they're going to start moving higher. So we're watching all of the different data points pretty closely. We're also seeing that when people switch jobs, they're not getting as much of a premium in pay, as much of a bump up in pay when they're switching jobs. So we have a lot of signals that there's some softness in the labor market. Now, we could muddle along and bounce along here with this softer labor market and be just fine, or it could start to turn negative, right? And so I hate to say data dependent, but at these parts of inflection points, you have to be data dependent.
It feels as though we've been part of an inflection point for a very long time. At what point do we just get a boost from the fact that the U.S. equity market is at all-time highs? You're seeing a rally into bond markets. You're seeing companies able to borrow. How much will that keep things afloat and sort of offset any weakening that might be happening?
Yeah, I mean, I don't think that we've been at sort of this inflection point for a long time. I mean, in 2023, we were very much in the camp that we were going to continue to grow, that there were a lot of forces that were going to propel that. And one of the forces that is propelling the stock market higher, of course, is the productivity story. And so, yes, that's helping a certain segment of the economy, but we're getting back into that K-shaped economy where the bottom part of the K is feeling the pinch. And like I said, you're seeing an uptick in delinquencies in auto loans, an uptick in delinquencies in credit card loans, and that is a sign of weakness. And that's a sign that people are really feeling the pinch of higher for longer rates.
When you're doing your analysis, the last data report was one of the lowest we've seen in terms of survey feedback since 2002. There's been a lot of questions in the market about how reliable is this data, but you're also scraping the internet for all what companies are saying.
Correct.
What do you rely more on? What do you think is more tangible, real data that shows what's happening in the economy?
I think that saying you're going to rely more on one thing than the other thing is not the right way to look at it. What you need to do is you need to triangulate from a number of different data sources. And any time that you have a regime change, you're going to see data that becomes noisy, right? When data starts becoming noisy like this, it's an indication that there's a shift afoot. And so we're very attuned to the fact that there is this underlying weakness, and it's sort of which comes first, right? The Fed rate cut and all the things that come along with that. And obviously one rate cut isn't going to do it, right? It's the promise that we're going to cut rates to the point where we can have a positive sloping yield curve. That positive sloping yield curve then changes the game with regard to lending, and it's a whole series of things that have to happen. And that's why I think the timing is very tenuous, because we're starting to get this weakness already, and the Fed is very unlikely to cut in June or July.
How does immigration play into how you're viewing the labor market? Because that supply side story has been really huge and able to keep wages down.
Yeah, and that was really significant when we had a very strong labor market, right? We had a tight labor market. More labor supply allowed the labor market to come into better balance. And now that increased labor supply, it could become part of a problem. Now, we think on balance it's good, and in the long run it's very good, right? We are, like most developing economies, we have lower birth rates. We're facing a world where we might have population declines. And so, I mean, not in the developed world, not in the emerging markets, but, and that changes the game in terms of economics. So long term, it's good for the economy, but in the short term, we could see some softness in the labor market.
You mentioned the K. Is it worse for the bottom leg of the K?
Oh, yeah. It's worse for the bottom leg of the K.
I don't think we've talked about that nearly enough. Could you give some time to that, please?
Yes. So first of all, when you look at the inflation data, and I think everybody knows now, I do this tweet every single month when the data comes out, and I look at the price increases from February 2020 to now, and then I annualize them, right? Because the absolute numbers look big, but the annualized numbers are still pretty big on a lot of components. And if you don't have a lot of disposable income, you're forced to pay. Those prices become much more onerous for you. And also, I mean, if you think of something like insurance going up, right? That's a harder thing to swap out than, say, beef prices go up. You can say, oh, I'll swap chicken.
So true.
Right? Swapping out your insurance carrier is a much more onerous thing. It can be done and you can push back, but it's not an easy substitution. And so people, I think, feel that they don't have a choice. And so that leads to not only the actual impact for households, but how they end up feeling. And it's sort of why you see in surveys like consumer confidence surveys, you see them so depressed, even though we've had this sort of 3-year expansion.
I think this goes some way, in fact, goes quite a large way to explaining what a lot of people might call an inconsistency between how people feel and what the data tells you. How people feel is in the data, isn't it? Isn't that basically what you're saying?
Yes. Yes.
All you have to do is look at the
inflation data, and you see that's how you can see why people feel the way they feel. And of course, we need to be forward-looking. The Fed needs to be forward-looking. And if we look forward, you can see that that's not going to continue, right? But that's not people in the street who are just living their lives, that they're not thinking about that. They're not thinking about what it's going to be like going forward. They're worried that the past is going to continue.
We hope it doesn't continue, and it's fantastic to catch up with you. Thanks for breaking that down. Constant Hunter there of macro policy perspectives on the recent economic data. Much more economic data still to come at 8:30 Eastern Time. We get jobless claims, and of course, before that, we should get some numbers from Walmart. The question that we've been asking around this table, do you look at the companies or do you look at the data? Got a bit of an answer. Look at both.
Yeah, you have to look at both. I go back to what Mohamed El-Arian had told us about when everyone was in this transitory camp on inflation in 2021. What he said was they weren't listening to CEOs on the calls saying that inflation was still in the pipeline.
Walmart's been talking about deflation, haven't they?
Well,
Walmart execs recently.
Yeah, let's see how that goes this time around, given the fact that maybe we've seen some reversal. How much is Walmart, though, a real read on that lower K shape, and how much is there a lot of downshifting from people in the upper tiers? There are a lot of questions with Walmart. Very curious to see the earnings.
I'll say the B word again, both. I think both.
Right.
Coming up for the next hour, here's the lineup for you. Mona Mahajan of Edward Jones. We'll catch up with Libby Cantrell of PIMCO, Chuck Grom of Gordon Haskett, and we'll speak to Michael Collins of PGIM Fixed Income. Equity futures on the S&P just about positive, following all-time highs on the S&P and the Nasdaq 100 from New York. This is Bloomberg.
Operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components because we're not developing those internally. We're using the existing aerospace defense supplier base for most of the other components.
We invest a lot in the offices, that you feel home, that you can actually be at your best yourself, and people work very differently. We take a lot of input from the sports world, actually, the athlete spirit, right? Building a sports team that can perform at the best, but also talking a lot about the explorer spirit. How can we really tap into new things, continue being disruptive? We have 80 different nationalities at On. It's very important to have a diverse team because we have a very diverse landscape of customers.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The fact is, we're in a healthy nominal GDP environment. That's a good environment for earnings.
We would probably see a market that would keep running here.
I think the market has positioned itself for quite a positive perspective.
I would be a bit cautious, especially if we have another material leg higher in equities.
I've got 5,400 on the S&P 500 by the end of this year or the end of this week. I'm still working on the timing.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg, and this is your equity market at all-time highs coming into Thursday on both the S&P 500 and the NASDAQ, closing at records yesterday for the first time since March. The year-to-date gains up by more than 11% on the S&P 500. Lisa, on the NASDAQ, up by more than 10.
Fueled by what? And this is really the key question. Initially, it was that the market could hang in there because rates were rising for the right reason. Now it's the market can hang in there because rates are probably going to keep on going lower because we're in this Goldilocks sweet spot. What I keep hearing from all of our guests is we're dancing on the head of a pin between the idea of some strength and Goldilocks versus some real weakness.
So let's get you some data. At 8:30 Eastern time, we'll get jobless claims right now. We get some numbers from Walmart. I'll bring you the numbers briefly. First quarter adjusted EPS, 60 cents against an estimate of 53. That's a positive surprise. Second quarter adjusted EPS, the outlook, 62 cents to 65. The estimate was 64. Lisa, the stock up about 2% in the pre-market.
Really pointing to the e-commerce penetration and how much they've really gained market share there, which we've been focusing on quite a bit. The idea here that they did beat pretty much across the board raises this question: how much is this really about consumers feeling stronger, and how much is this Walmart consolidating some of their market share? Walmart only U.S. stores, ex-gas, up 3.8% versus the estimate of 3.4%. Sam's Club, an even bigger beat of 4.4% versus 3.3%.
We often ask this question when they deliver results. If it's good for Walmart, does it mean it's good for the economy? This is the commentary coming from the CFO speaking to Bloomberg. We're seeing customers trade into Walmart. We've historically been thought of for value, but now it's value, quality, and convenience. It's the higher income consumer going over there.
Yeah, and some of that has to do with the fact that they are looking for potentially better price points. You can find that at Walmart, but also that they are offering ways to get Walmart online, in store, or go to the store, pick it up, the same way you'd see from like a Target or Amazon. So now they are competitive in this space. Also interesting, I know they are trimming a little bit on the corporate side. We heard that earlier from the Wall Street Journal this week. Interesting to see what they're going to have to say about potentially trying to make internally trimming some of those costs and making it more robust for the future in terms of the corporate headcount.
So it's a beat on the top and bottom line. Just to go through this again, revenue's a beat. First quarter adjusted EPS is a beat, 60 cents against an estimate of 53. The outlook for the second quarter adjusted EPS 62 to 65. The estimate 64. And it looks like the high-income consumer is flocking to Walmart. Walmart in the pre-market slightly positive off the back of these numbers. Walmart in early trading is up at the moment by about 1.6%. That's the story for Walmart. Coming up on this program, we'll catch up with Mona Mahajan of Edward Jones with stocks at all-time highs, PIMCO's Libby Cantrell with the first presidential debate set for June, and Chuck Grom of Gordon Haskett reacting to these numbers just dropping from that big retailer. We begin with our top story, stocks at all-time highs following the lowest inflation print in 6 months. Mona Mahajan of Edward Jones writing this: if we see a Goldilocks cooling of the economy, markets may welcome this outcome. While this scenario continues to be our base case, the tail risk is a more rapid downturn that also leads to rate cuts, but for the wrong reason. Mona joins us now for more. Mona, if Walmart is doing well, what does it say about a broader economy?
Yeah, thanks, John. It does feel like it's consistent with the narrative we've been getting over the last several days, which is retail sales have been cooler. The labor market looks to be moderating. Perhaps more consumers are headed to Walmart to get that better discount. It does feel like the consumer feels a little bit stretched, but of course we're watching that lower income consumer more so than the broader economy. Now keep in mind, both the labor market and the consumer started from a position of strength. So when we think about cooling, it's cooling from a very strong base. And so the scenario that we laid out, what we call a Goldilocks moderation of the economy, really means that the economy could soften a bit, but we're still talking about at trend levels, maybe slightly below trend levels. That kind of cooling also, keep in mind, can lead to better inflation trends. So if we are at the start of a bumpy ride lower in inflation, a Goldilocks cooling in the economy, that's an environment that the market will welcome. What they don't want to see is a more rapid decline, and that's what we're on the lookout for. We don't see it yet.
Well, what you're going through, and I think what you're setting up, is something we've discussed on this program for a while, the difference between a welcome cooling and an unwelcome deterioration. Can we turn to the labor market? What's the labor market telling you versus, say, what corporate America's telling you?
Yeah, I think the labor market's an interesting story here. Of course, at 3.8, 3.9% unemployment rate, still near multi-decade lows, so still relatively strong. But what we're seeing is better supply and better demand, or a more balanced supply-demand picture. And I think the Fed has highlighted this as well. We are seeing on the supply side more workers returning to the labor market, perhaps after that pandemic hiatus. We also have the immigration story working in our favor from the supply perspective, but we are also seeing job openings move lower. So the demand for that labor is coming down. The supply of that labor is moving higher. We think that will lead to a nice cooling in the wage gains figure. And that's what we really want to see for services inflation. What we'd say more broadly also on the labor market, some of those leading indicators, not only job openings, but the quits rates. Keep in mind, folks are not quitting their jobs like they once were, perhaps because there's not as many openings to go into after you quit your job, but that tends to be a leading indicator for the labor economy. We could see an unemployment rate tick higher, perhaps above 4%. But in our view, that is still healthy and probably not getting much more beyond that.
So dancing on the head of a pin of this Goldilocks type of situation that seems to be great for stocks no matter what, regardless of how far we push on either direction. What would trigger some sort of end to this Goldilocks that so far has been an absolute panacea to stocks, and you see it continuing to be?
Yeah, look, I think that's what we are all thinking about. We had our first correction earlier this year. It was only about 5.5% peak to trough in the S&P 500. What we were really thinking about is what would lead us to become, for that correction to become more nefarious. Would it ever turn into a bear market, a 20% plus decline? Historically, when we are in that environment, when we are entering a bear market or in a bear market, we tend to see a few factors in place. One, the economy is usually hitting a recession. We may not be in it yet, but we're heading in that direction. Two, the Fed tends to be raising rates pretty aggressively. And then 3, there's usually that unknown shock factor, which is hardest to handicap. But I'd say when we think about the first two, either a recession or Fed raising rates aggressively, that doesn't seem like a likely scenario as we look forward. So again, you know, we don't expect that 5.5% correction to be it this year. We are headed towards an election season, et cetera. There could be more volatility ahead. But as long as we feel comfortable that that volatility doesn't turn into something deeper or more prolonged, we think it's an interesting opportunity for investors more than anything.
In the meantime, a lot of people have been waiting for that pivot point to really start to broaden out. We are seeing some broadening out in specific sectors, but broadening out to small caps and some of the value names you see as really coming into play when we actually see rate cuts. Won't it be too late then? Don't you kind of have to get ahead of it?
Yeah, it's a good point. And look, I think as we get opportunities along the way, any of that volatility that we noted earlier, that is a great opportunity to not only diversify, make sure you're balanced in your growth value cyclical portfolio, but thinking about rebalancing, thinking about adding those quality investments at better prices. We do think, one, as we get closer to Fed rate cuts, that will be a catalyst to unlock a more sustainable broadening of market participation. But 2, as we head to the back half of the year, what we're seeing in earnings growth is that earnings growth contribution becomes more balanced between those growth tech sectors and those cyclical and value parts of the market. You know, Q1 and even Q2 to some extent, really driven by tech, Magnificent Seven, outperforming on the earnings front. But as we get more balance on earnings, as we get closer to Fed rate cuts, and by the way, if inflation continues to moderate, that's a good environment for a broadening of participation, not only between growth and value in U.S. equities, perhaps international continuing to play some meaningful catch-up. And by the way, of course, your bond portfolio is starting to look a lot more interesting too.
Mona, you talk about the probability of September rate cut was moved up higher, but what do you make of Neil Kashkari yesterday basically saying we might need to stay here a lot longer?
Yeah, you know, we think higher for longer should be the base case, and whether it's September, December, or even early next year, the longer, you know, for longer-term investors, the narrative really is the Fed was embarking on not just a 2024 rate-cutting cycle, it was 2024, 2025, 2026, so a 2 to 3 year rate-cutting cycle to get them at least somewhat closer to a neutral level. So we do think they are on that path for a multi-year rate-cutting cycle. They will need to see as a prerequisite to that, as many of us have talked about, at least probably 2 to 3 better inflation prints. Now, we got a good one this week. Hopefully that resets the clock and we get a couple more in the months ahead. The one thing I'll say is I do think it's interesting the way the narrative is setting up for September, December, and then March. So this quarterly pace of rate cuts could be an interesting one for the Fed. At least it takes a little bit of the uncertainty out of it, makes it a little bit more systematic. If they can get the data to fall into place, I think that could be something they consider down the road as well.
Hey, Mona, appreciate the reaction to the earnings from Walmart and the commentary on the broader market. Mona Mahajan there of Edwards Jones. Here's the lineup for you for Fed Speak. Lisa, Barr, Barkin, Harker, Mester, Bostic. Just tons of them going into the weekend.
And we already heard from John Williams saying things are good where we are. We heard from Jay Powell. He's disappointed there isn't more progress. We know that we're probably going to have a more hawkish Mester. We know that probably what we're going to hear from Raphael Bostic is maybe even no rate cuts. Will it matter? That's my question. Ultimately, will the market really care?
And how much time do they have, I like to think, before the election? Everyone's talking about this probability of September going up. How perfect do these next data points have to be? Williams already hitting the tape this morning. I don't expect to get that greater confidence that we need to see on the inflation progress toward a 2% goal in the very near term.
Nobody's changing their base case in this market or seemingly on the FOMC following the data from yesterday, given how many times we've seen a head fake over the last 12 months when it comes to so-called disinflation. Just a final word on Walmart. Danny's going to go through the numbers. That stock is higher in the pre-market by more than 5% in early trading. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Yeah, it's backed off. It was 5.9, now about 5%, as you say, John. So just to recap, first quarter earnings beat expectations, and at the same time, it now expects the full year results to be slightly better. So e-commerce, that was one of the big drivers. That jumped 22% in the period. But as you all also noted, Walmart said that upper income shoppers are now flocking to the retailer too. The CFO told Bloomberg, quote, "We are seeing customers trade into Walmart. We've historically been thought of for value, but now it's value, quality, and convenience." To geopolitics, Chinese President Xi Jinping affirmed that the relationship with Russia remains strong. He told Vladimir Putin that ties between the two nations should last for generations. Putin's trip to Beijing is his first foreign visit since he started his 5th presidential term as Russia intensifies its war in Ukraine. Putin described the ties with China as, quote, one of the main stabilizing factors in the international arena. Now, the very volatile copper rally is showing no signs of slowing down. It's because of a short squeeze in New York, and that's pushed COMEX prices to $1,200 above LME prices. That is an unprecedented level. Usually the spread is just a few dollars. Copper prices have been rising for months across the board, but this week's surge was specific to just the COMEX commodity exchange. High demand, low inventory, and global shipping issues have created the wild swings in prices. And that's your Bloomberg Brief, John.
Danny, thanks for the update. We'll catch up with Danny again in about 30 minutes' time. Danny, going over the Walmart numbers, a beat on the top and bottom line. That stock is higher in early trading by 5.5%. Chuck Grom at Gordon Haskett about 20 minutes away to break down what he sees in these numbers. Up next on the program, the presidential race ramping up.
My advice to the Biden administration, if you're in denial, you're not going to solve your problems. And they're kind of in denial of the problems they have.
That conversation just around the corner, live from New York City this morning. Good morning.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Equity futures just about positive on the S&P 500 by 0.1%. In the bond market, yields just about unchanged, 433.80. Jobless claims 1 hour and 15 minutes away. Under surveillance this morning, the presidential race ramping up.
The Republicans are going to win the Senate. It's a simple math question. The presidential election, it's still up in the air, but you look at every polling today, Trump is in the lead, and Biden's doing nothing to change that. My advice to the Biden administration, if you're in denial, you're not going to solve your problems. And they're kind of in denial of the problems they have.
I'm not sure if the Biden team is looking for maybe advice coming from the former Republican speaker, but there it is. Here's the latest this morning. President Biden and former President Donald Trump agreeing to at least 2 debates ahead of the November election. The first set for June 27, making it one of the earliest in modern history. Libby Cantrell of PIMCO joins us now for more. Libby, good morning to you.
Good morning.
How important is that June date?
I mean, it's important. So what we're telling clients is it's still early in terms of polling, so don't extrapolate from the national polls or even the state polls. However, I think the Biden campaign is looking at those polls, and they are concerned, particularly in terms of what it means for the Democratic coalition, which are sort of Hispanics, Black folks, and then also young people. There is really fragility in those demographics for Biden, so I think this is his opportunity to sort of reach out to those folks to really make this less of a referendum on his own administration, more of a choice between both President Biden and former President Trump. We'll see how effective it is. Also, the June date also gives him some runway, so if it doesn't work out very well, it's not necessarily existential for his presidential campaign.
How odd is it to have a debate before they even go to the RNC and the DNC?
I mean, as you know, very odd. It's actually never happened before. And usually, of course, the Presidential Commission on Debates is the one who sets the rules, sets the dates. It behooves them to have the dates closer to the election because more people are tuned in. So this is really sort of another erosion of norms, if you will, in Washington in terms of circumventing that process. But I think it really does show you that the Biden campaign is trying to sort of flip the script here. They want to change the narrative. They want to get out to voters, and they think this is a way to do it.
How is it that they can't change the narrative when the individual they're up against is sitting in a court almost every single day of the week?
Yeah, well, look, what we talk to our clients about all day long is this idea of gas and groceries. The price of a gallon of milk, the price of a gallon of gas, these things really, these are sort of kitchen table issues, these things really matter to voters. And this is one of the reasons why, President Biden has been polling so poorly on the economy, even though on paper the economy, to all of us, look pretty good. But for the average voter, it doesn't. And so, yes, President Trump is sitting in that courtroom, but it really isn't swinging public opinion. This is the interesting thing. This is kind of already priced into the polls. And so, maybe short of a conviction, it doesn't seem like anything will really move folks. Now, if we do get a conviction, that might be sort of a different ball of wax.
Earlier this year, there seemed to be a reluctance on the part of Wall Street to really coalesce around Donald Trump. That seems to be shifting. The corridor between New York and Washington, D.C. seems to be getting busier. Why?
Yeah, well, I think that, like kind of the broader voters, folks want change. And I think, it's interesting, actually, just as an example of this, even the reaction to President Biden's announcement he's going to continue the 301 tariffs on China, and he's actually going to increase tariffs. That, under President Trump, did receive a lot of pushback on Wall Street. The announcement that was made earlier this week, it didn't even really move folks. And I think it just shows you that in many ways, people are sort of embracing some of the Trump-era policies, that they do believe that, maybe he was onto something as it relates particularly to China. And then, of course, you sort of see what's happening in terms of these two wars that folks are fighting, that we're fighting, overseas. Again, inflation. So I think people want to change, and that includes Wall Street.
The interesting part to me is that analyst reports that are coming out right now, also, they used to be like the administrations are polar opposites when it comes to policies. Yeah. Now, every single one of them is maybe on the surface, but you look underneath and it's exactly the same. Do you buy that? Is that sort of the state of play right now?
Yeah, so of course there are differences, but I think that there are some really important similarities between these two gentlemen. First of all, they're not actually that different in age, and so in some ways they sort of grew up in the same generation. I really do think that they're both, more protectionistic at heart. And of course, we've seen that from President Trump, but we've also seen that from President Biden. President Biden was known as sort of Union Joe on Capitol Hill, and I think he's sort of lived that out here in terms of his administration. The other similarity, is just their approach on deficits. And I think this is actually a nuance because all of our clients are like, of course they're going to be bad for deficits. Trump will cut more taxes and Biden will spend more. That might be true. But I actually think the reason why structural deficits are going to be so high is because neither gentleman wants to do anything in terms of Social Security and Medicare. And if you look at actually the big source of government spending, that's the elephant in the room. And so unless Washington really tackles that, and of course these are really important programs. Social Security has lifted seniors out of poverty, so it's not to say that they should dismantle those, but without reform, those programs will continue to be a huge drag in terms of a big source of fiscal deficits, and neither has any sort of political appetite to address those.
You sit around the table with a fixed income team at PIMCO, and what's everyone saying? Are they saying we're going to get pushback from the Treasury market?
In terms of deficits?
Yeah.
You know, so we have we had our secular forum, as John's very familiar with this.
I didn't get an invite this year.
I'm sure it's in the mail. That was a mistake
from last week.
You know, so we did talk a lot about sort of this idea of just higher deficits for longer. You know, the CBO is estimating sort of 5 to 6% deficits. You add back the expense of the Trump tax cuts, that goes to 7% every year. But does it matter? And I think this is the big question for bond investors. Does it matter? Is the U.S. sort of so exceptional that it can continue to spend, and continue to deficit spend? And I think that we're certainly worried about the sort of the longer term fiscal picture. At the same time, the dollar continues to be the reserve currency, and I think importantly, the Treasury bonds continue to be the reserve asset of the world. And as long as that continues, likely the music will go on for a little bit longer.
At least I know this is a massive focus for you going into November, if not the focus.
Well, yes, actually. And, we talk about this and people shrug it off, the Liz Truss moment, this idea that there could be some policies, some tariffs, something that would trigger both an inflationary push and bigger deficits that could be the moment. What I find interesting is structurally, this market has not changed in terms of primary dealers, so it is getting bigger and bigger with a smaller sort of vice around, relatively speaking, around the corner. Do you see that as a possibility, that kind of
the Liz Truss moment? Yes. And one of our colleagues, Tony Krasinski, calls this the read my lips moment, where you have politicians sort of saying something and then the market reacts. I mean, certainly, and again, we don't want to be too sanguine about this because we are absolutely concerned just about the sort of the fiscal picture over the long term. I do think that there are some pretty important differences, though, between kind of the UK and the US, just in terms of their the way their politics works. And importantly, we likely will have a split Congress under whomever is the next president. And even if there's unified control, if Trump wins and the Republicans win both chambers, it will be by very small majorities. And I think that will actually sort of hamstrung Congress in terms of how much they can do. So when Liz Truss was talking about all of these things, she had a cooperative parliament, right? So if Trump is talking about these things, he probably won't have a cooperative Congress, and the same thing for Biden. So I do think this sort of checks and balances actually does reassure the market, and it should, because it can in some ways be kind of the brakes, or at least slow down some of that spending.
If you're looking at a split Congress, what did you make of Speaker McCarthy saying the Senate's going to go GOP?
Yeah, so, as many of us know, so 100 members of the Senate, 34 up for re-election. Of those 34, 23 are being defended by Democrats. So Democrats just have a horrible map. If you look at those 23, Amber, you know this very well, 8 or 9 are very vulnerable for Democrats. They're in places like West Virginia or Montana or Ohio. So it does seem that higher odds here that the Senate flips, but I do think there is some nuance here that it's probably going to flip by 1 or 2 or 3 seats. But so if it does flip, it's going to be a very small majority control. We're not going to get up to the 60-vote filibuster threshold, which is the important, in terms of actual additional spending, that's the important number, and neither party will have that regardless of the outcome.
Libby, when you speak to clients, how interested are they in the VP race?
Very interested.
What do you say to them?
Again, number one question, that and the Fed, honestly, in terms of what Jerome Powell will do in an election year. I think that President Trump, kind of give credit to where credit is due. He is running a much, by his own admission, a kind of a much more strategic, professionalized campaign than he was in 2016. Again, by his own admission, where they sort of were surprised by their victory. This is much more kind of strategic and what have you. And as a result, I think you'll see that in the vice president choice. It's either going to be offensive in terms of trying to shore up some of the opportunities among Hispanic and Black men, or it's going to be more defensive. And I do think this is actually a big liability for Trump that folks aren't really talking about, is just with independent women. He is, I think President Trump, one of the reasons why he was elected in 2016 was because of this demographic. In 2020, Biden was helped out by them. So I do think they're a big and important swing factor, and so I think you could also see him pick a woman. So it's either going to be kind of an offensive selection or a defensive selection, or it's going to be J.D. Vance, which sort of fits neither category.
Or Nikki Haley, which is what we talked about briefly yesterday. They've distanced themselves from that a little bit, but keep going back to that name.
That would be the entire party, bring in a lot of donors.
Big time. Libby, it's good to see you.
Good to see
Thank you. Libby Cantrell there of PIMCO. Coming up on this programme, shares of Walmart rising after the company reported surging sales. Chuck Grom of Gordon Haskett joins us next with that stock higher by 4.6%. Live from New York, this is Bloomberg.
of politics to the world of business. Every weekday on Bloomberg TV and radio, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis from and about politics' biggest power players.
The president has been clear that is non-negotiable.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday, only on Bloomberg Television and Radio. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Live from New York, welcome to the program. Jobless claims about 60 minutes away. Equity futures on the S&P 500, just about positive by 0.1%, up 0.2 on the Nasdaq. The Nasdaq 100 on a 5-day winning streak, the longest since the back end of March. On the Russell, doing okay yesterday, just about unchanged this morning. Switch at the board and turn to the bond market. The levels we've been through and back down again. We were looking at 5% coming into May. We're back down to 4.75 on a 2-year. The 10-year not so long ago in the 4.70s. Lisa, all the way back down in the 4.30s.
And it's really come from real yields, basically the inflation-adjusted yield that you're getting on treasuries. Libby Cantrell was very diplomatic there, talking about how they have to care about the deficit. But basically, this is a big resounding cry. People have to give lip service to it, but in reality, they are not concerned about it at all. And right now, what is affecting the dynamic is a sense that we're not necessarily going to a 5% inflation rate ad nauseum, and that the Fed will be lowering rates.
Let's turn rates to the FX market. I got all that, just about. Looking at rates yesterday, yields lower, dollar weaker against everything in G10. The dollar this morning stronger against everything in G10, including against the euro at 108.67. We're negative on that currency pair by 0.16%. Under surveillance this morning, the US warning Israel it risks creating a power vacuum across parts of Gaza, urging it to focus more on post-war planning for the region. Secretary of State Antony Blinken telling reporters, quote, "We can't have anarchy and a vacuum. That's likely, Lisa, to be filled by chaos."
This is a real problem that even some people within Israel and within the Israeli governing committee have raised. I mean, even the defense minister has said there is a problem with a lack of a plan coming from Netanyahu's camp. Again, we've talked about red lines. They've been crossed. We've talked about weapons delays. They're being shipped. What more levers does this administration have to pull at a time where, yes, he is polling poorly, and yes, in certain places, because of this issue?
I think this weekend will be critical. You have Jake Sullivan going over to Israel, also going to Saudi Arabia. Potentially, there's going to be more pressure exerted on Israel, and then when he goes to Saudi, it's can there be any deal that could get done? The problem the Saudis have is that they're not going to have any normalization with Israel if what happens in Gaza continues, which at the moment it looks like it's going to be continuing for quite a while. And if the Saudis want any sort of just U.S.-Saudi defense pact, will the Americans take that without that cherry of normalization with Israel, which was supposed to be a crowning foreign policy moment for this president?
Can we just sit on Rafah just for a moment? What's the state of play now? Seems to have gone quiet, at least over the last couple of days.
Looks like the state of play is that they are trying to move out the more than 1 million Palestinians that are stuck in Rafah. A lot of those individuals had come from the north, went to Rafah in order because they knew that Israel was coming in from the north. That's one thing. Two, this is very concerning for Egypt because it's right on their border, and potentially this is going to go against the peace agreement Egypt has with Israel. And the second is Israel's going in slowly, trying to still take out leaders of Hamas. Potentially, though, will we see a massive ground invasion? That's the big question mark.
That's the latest on the war in the Middle East. Here's the latest on Microsoft. It's asking as many as 800 employees in its China-based cloud computing and AI operations to consider transferring outside the country as tensions mount between the US and China, according to reporting by the Wall Street Journal. The company employs about 7,000 engineers in the region, with most, Lisa, based out of China, and the pressure, I imagine, on immigration lawyers to try and sort some of this out sometime soon.
The most interesting part of this story worry is that it got leaked out. Because honestly, how many companies must be doing this? How do you have cloud computing specialists who have the expertise, who are Chinese nationals in China, working on technology that the US government says is national security issues and has to be reserved to the United States? This is ultimately a question of what are companies doing behind the scenes in addition to what Microsoft is saying. They're all probably thinking about their game plan as well.
My question for Microsoft is, are you decoupling or diversifying when you move these jobs out of China? Is it a diversification play? I'm obviously taking a crack at what the Biden administration has called, we want to diversify, not decouple. But clearly, the direction of travel remains the same for these tensions between Washington and Beijing, and companies can't just sit on the sidelines and wait.
Well, we know what officials and companies say on the record. It's diversify, not decouple, because that's politically acceptable to say, of course. I want to turn to Walmart. The stock is up by 4.5% in the pre-market. They're reporting first quarter earnings that beat estimates and forecasting better than expected full-year results. Their stock is up by 4.5%. E-commerce was a big driver, jumping 22% in the period. Walmart saying upper-income shoppers are flocking to the retailer. Chuck Grom of Gordon Haskett joins us now to discuss. Chuck, you've had 30 minutes or so to go over this numbers. What jumps out for you, sir?
Yeah, I mean, on the top line here, 60 cents of earnings, 8-cent beat, high quality, better gross margins, better sales, better membership income. And I think that ties into your point just now on them starting to lure more higher income customers into Walmart. Inventory is in great shape. I think the real story here is actually below the top line, though. We started, for the first time in a long time, really strong EBIT dollar growth ahead of sales growth. So starting to leverage in the P&L is really something that the long-only community has been really waiting to see for Walmart. So a really impressive print, and probably was a pretty tough quarter for retail in the first quarter. I mean, we'll get more results in the next couple of weeks, but we're pretty happy with the numbers this morning.
Chuck, where's that coming from? How are they able to squeeze more from the top line to the bottom line?
Gross margins were really successful. Their price leadership continues to do really well. Markdowns were lower year over year. That ties into their inventories being under last year's balance pretty significantly. And we're finally starting to see some of their other business mixes starting to impact the P&L, namely advertising and data. Very high margin, high accretive businesses starting to creep into the P&L, which is frankly a good creep finally.